Good morning, everyone. Am I audible to all of you? Let us just wait for 1 minute. Let everyone join in. Then we will start with this intensive 25 hours AFM marathon. Let me just update in the group that I'm live. Good morning, everyone. Am I audible to all of you? Is my audio absolutely comfortable for all of you, friends? Yes, I have informed everyone. Good morning, Sarvamangala. Good morning, Anu. Good morning, Linda, Deepthi, Durga Prasad, Aishwarya, Deepthi, Shana. Good morning, everyone. I hope I'm absolutely clear and audible to all of you, friends. Let me just check the audio settings. Yes. Perfect. I think I can see you all now. Okay. Just confirm about the audio one. Yes, yes. The audio also looks to be absolutely clear. We'll just wait for 1 more minute, friends, and then we will start off with this intensive 25-hour AFM marathon. Perfect. Thank you, Aishwarya. Thank you, Shilpa, for letting me know that. All right. I believe all of you have joined in now. Shall we begin with today's session? Please type a yes in the chat box so that I can start off and give you a big introduction about how we are taking this thing forward. Ready? Perfect. So, friends, welcome to today's 25-hour intensive AFM marathon. Friends, this 25-hour marathon is a very, very successful batch that I'm launching free of cost for all of you so that we both can study together, so that we both can win together. Friends, I believe since you're all CA final students, you would have heard about Pareto analysis. What does a Pareto analysis tell you? It tells you that 80% of your results normally come from 20% of your efforts. This is something which is actually true because the major part, if we can cover in a shorter span of time, you can definitely score excellent marks in the exam. I had done the same 25-hour marathon a few years back, and trust me, friends, the students who attended that, many of them passed only by attending the 25-hour marathon, which is not at all advisable, friends. It is only advisable for those who have absolutely no time, right? Are attending for the first time, just want to learn something and go and write. But there are people who have scored at 40 plus by just attending the 25-hour marathon, by just investing these 3 days plus the extra study days at their home. So, friends, right now, the objective of this 25-hour marathon is that I want to cover the entire area in this short span of 25 hours, wherein I will give you a brief explanation about the concept. There are two things coming in. One is concept, and the other one is problems. Correct? Concept, in my class, I'll be giving you a brief explanation. Plus, as you proceed, I will give you a link to one of my websites where you will be getting free detailed concept videos also. So that way you can learn the concepts in an elaborate manner if you want, or if the brief explanation is more than enough, that would satisfy all your areas and all your doubts also. After that, we will do problems. These problems, what we do, will be the tough problems. These problems, what we do, will be the past examination problems only. And when I do this problem, I will explain every problem conceptually and we will do it. So we'll write the basic data, I will explain the logic, and we will go on solving. Is everybody clear with this part? And at the end of the class, okay, whatever I keep you in writing, you please note it down. At the end of the class, this handwritten notes of mine, I will export it and I will share it to the WhatsApp group which is already there. I presume all of you are familiar with the WhatsApp group. If no, please let me know. I will arrange the link for all of you. Okay. And even before I forget, if you have any doubts about this 25-hour marathon, you can always message the helpline number, which is 6238 017 100. Okay, so you can just note down this number, and any doubts you are getting which is not being sorted over here will be sorted out with the helpline number also. I hope you are all clear with how we are going to go ahead with this part, friends. Please type a yes in the chat box. Perfect. So shall we begin with this part, friends? Yes, even before I begin, there is one more thing that I need to note you. What is the material source that I'll be using for this one particular 25-hour marathon, friends? For this 25-hour marathon, I will be doing it directly from my mastery book. Now, for those of you who don't know what is the mastery book, friends, mastery book, I'll just show you a sample here. This is the mastery book. This mastery book covers the entire concepts in writing in a very, very elaborative manner. So, for example, if you want to learn how to value a bond, you just have to read through this, and with the self-explanatory with a lot of examples given over here. Now, after reading this, if you still don't understand, you have a QR code over here. Why is this QR code? You can scan the QR code and my video about how to value a bond will start playing. So that way you can learn it from this book. It took me a lot of years of effort to create this book, but since it's out now, it is extremely useful for all the students. And apart from this, towards the end, we have covered the last 10 years of question papers, RTPs also in this book. By doing so, this book contains a big database of effective relevant questions. So when I say effective relevant questions means I don't want to add unnecessary questions. We have 375 questions in this book, friends. 375 effective questions which are either past examination questions or study material questions, or this is a past RTP or MTP question. Everybody clear with this part? Now, many of you might be having this doubt, how do I access this book, friends? For that purpose, we have two categories of students who are attending my YouTube live right now. One, those of you who are already my students. I can see many of the names which are familiar to me over here. Divya, Sarvamangala, I know a lot of you who are already attended my classes earlier. So all of you already have attended my class and you already have access to the ebook, if I am not wrong, correct? In case you have missed out on the access, just message on the helpline, they will arrange the access for you. Okay. For those students who are attending my class for the first time, just for a purpose of, making them serious about this subject, making them serious about the studies, you have a small, very, very small investment to be made, friends. This ebook is actually available for a price of 750 rupees. But I don't want to charge you money for this particular thing, but I want you to be serious about studying for this topic. So as a part of that, after discussing with my team, we have come to a conclusion that any of you who want to buy my ebook as a part of this 25-hour marathon, you will be given an absolutely 50% coupon. You can buy this book at 375. Okay, so that's exactly half the price. For that, you need to use a coupon code. How? I will just explain to you in 5 minutes and then we will start off with this thing. So point number one, you will have to install my app. So you may be using either a Play Store or you will be using iPhone. In Play Store, you have to search for Tarun Jagdish. In iPhone, you will have to use the app called as Class Plus. So once you install this app, they will ask you for an ORG code. Here you have to go and give the ORG code as ELEVM. Alright. So once you enter this, you will automatically enter into my app. I'll share the link with you with the coupon code. This coupon code is applicable for the first 50 students, friends. I'll share the coupon code with you right away now. One moment. Yes, I'll just show you where the book is available. Once you install my app, you will have to go to courses. In that you have the ebook available over here, friends. It's actually priced at 750, but we have created a coupon code. And for this coupon code, the coupon code for purchasing this book is ebook September 25. So I'll just write down the coupon code over here. Please note it down. Books September 25. So the moment you use this coupon code, the price of the book, which is 750, will come down to 375. Apart from this, suppose you want a physical copy, you're not comfortable with the ebook, you want a physical copy that is actually priced at 1400, but for these students, I'm going to provide it for the cost that comes in, which is approximately around 1000 rupees. So for this, you'll have to directly message the helpline. They will arrange the book for you, friends. All right. Initially, if you want, it's comfortable for you, you can just view my classes, because anyways, I'll show you the book in the videos also. If that suffices, you can definitely take ahead and go ahead with that, because everything will be covered in the class. Even the screen will be shared. Just that if you want to do self-reading and if you want to work out extra questions and revise whatever is done in the 25-hour marathon, only then this book will be required by all of you. I'm sharing this in the WhatsApp group so that you all can, click on the coupon code and you can use it. I hope all of you are there in the WhatsApp group, friends. Perfect. So I have put these details also. Shall we now quickly begin with today's 25-hour marathon, friends? Are you all ready? Please type ready in the chat box. This is a 1000-page book and it covers everything. It covers theory, it covers problem, it covers concept, it covers additional practice questions also. Fantastic. So friends, with this, let us start off with today's session on AFM 25-hour marathon. So friends, I will now give you the study plan which is supposed to be followed by you. As far as the exams are concerned, I can categorize them into 2 parts or 3 parts if you want. Easy, moderate, and the last part is what we call it as tough. Okay, so when you talk about easy topics, the one of the easy topics that you have is security valuation. Then you have mutual funds. Then you have mergers and business valuation. These 4 are very, very easy. They are not very, very complicated. In the moderate topic, I would put portfolio management mainly, friends. And in the tough part, I will put forex and derivatives. Here I'll also add miscellaneous. You have got some small topics like value at risk, etc. also, which can come into the picture. All right. So what we will do is, friends, first we'll start with the easy topics, because in less time from the examination point of view, this entire area together will be covering around 60 to 70 marks. Everybody clear? Portfolio management, you can take a 10 mark. Forex and derivative will be either 20 to 30 marks. Hold on. Sorry, 10 to 20 marks. Am I right? That's how it tallies. 70 plus 10, 80. Yeah. Sorry, 20 to 30. That depends on how much is less there. Either 20 to 30 marks is what comes in forex and derivatives. So we'll be covering all the 3 conceptually also, problem wise also. So we start with the first chapter now, security valuation. All right. Wait, I'll open a new page so that I can share all this with you. So I'll call it as 25-hour marathon day one. This I'll share it in the WhatsApp group that we have. All right. So in case you're not there in the WhatsApp group, please join the WhatsApp. Yes, friends. So first, we are starting with a new chapter that is called as security valuation. In this chapter, we have two parts. Part one is what we call it as bond valuation. Part two is what we call it as share valuation. Okay. So yes, Takshinamurthy, capital budgeting also. Sorry, that falls in the moderate topic. All right. Sorry, I forgot to include capital budgeting in my plan. Thank you for letting me know about that. Okay. So we start with bond valuation, and the second part is what share valuation. Now, in bond valuation, we'll start with this part now, bonds. So tell me, friends, what do you understand from the word bonds? Or can you give me an example of any bonds that you're familiar with? Keep on chatting in the chat box, okay? So that way we will have a very high and a very intensive revision format over here, okay? Perfect. So now interact with me. What do you mean by the word bonds? Friends, bonds are basically risk free securities which are issued by the government. All right. So they are basically issued by the government. Yes, a zero coupon bond is one type of a bond. There are multiple types of bond. So one of the examples of a bond is NHAI. What is the full form of NHAI? National Highway Authority of India. So how this actually works is, friends, suppose this is one person. He is investing, let us say 10 lakhs in the bond. Like this person, there are hundreds of people in the market who will put money in the bond. This money, they will use it for what purpose? To construct. Everybody clear? And on this, NHA will do what? They will pay a small coupon rate, let us say 10%. Everybody clear with this part now? Okay. So this kind of a structuring is what we call it as a bond. Bonds are said to be risk free. Can you quickly scribble it down? I'll not give you too much time to write down, friends, because we have less time over here. But I'll give you 10 to 20 seconds per slide to write it down. Please write down now. All right. So I believe you're clear with the concept of the bond. Now I'll tell you what are the different types of bonds. First one is what I call it as a regular bond. Then you have a zero coupon bond. And finally, you have something called as a perpetual bond. All right. In a regular bond, let us say you will have a limited life, 5 years. You will have a face value, let's say 100. You will have a redemption value, let us say 110. Okay. I think these are the main things. Face value, you will also have a fixed coupon. Let us say 10% is the coupon that will come over here. Everybody clear with this part? But when you go to a zero coupon bond, it will have the same limited life. It will have a face value. It will have a redemption value, but it will not be having any coupon. Everybody clear with this part? Third part is a perpetual bond. This will have unlimited life. So it goes towards perpetuity. All right. It will have a face value. It will not have a redemption value. Why? Because it is having unlimited life, my dear friends. All right. And it will have coupon which will go on forever. I'll write down like this. Coupon forever. Can you quickly scribble this down in your books, friends? All right. Can I go to the next part now? The next question that we need to ask is how to value a bond. How to value a bond. Friends, value or valuation when you do, I need to just share with you one quick lesson which I elaborate a lot in my classes, but here we have less time. I'll just give you the brief of this. Value of any asset, value of any asset is nothing but it is the present value of future cash flows. Friends, any asset value will be how much money it can generate in the future. So, for example, tell me who's your favorite celebrity. Do you like Hrithik Roshan? His new movie has come in, War 2. So, shall we just check how much money he charged for War 2? So, let me just search Hrithik Roshan charges for War 2. This person has charged 50 crore to act in this movie of War 2. Why do you think the producers of the movie were so comfortable paying him 50 crore, friends? That is because they are very sure if Hrithik Roshan acts in the movie, that movie might generate a cash flow of 100 crore or 200 crore. So when they are getting 200 crore, do they have a problem paying 50 crore to Hrithik Roshan? The answer is no. Are you clear with this part, friends? Value of Hrithik Roshan is nothing but present value of future cash flows that Hrithik Roshan can generate. Now, friends, tell me any super flop actor that you have heard about. Have you heard of a guy called as Himesh Reshammiya? Shall we check how much money he charges for movie? Himesh Reshammiya. If you have not heard, please Google him. Charges for a movie. He is still charging 2 crore, friends. Why is he charging 2 crore? That's because he is able to generate a revenue of more than 2 crore. Otherwise, nobody will be paying him this money. Friends, this is a universal reality. Value of any asset is nothing but it is the present value of future cash flows. Do you know Zomato? You all use Zomato and Swiggy app? These two companies are approximately valued at $10 billion. How have they arrived at this valuation? They have taken the present value of future cash flow. So just keep this one rule in your mind, friends. Value of any asset is nothing but it is the present value of a future cash flow. So keeping that, if you want to do a value of a bond, if you want to do a value of a bond, there are three types of bond. What is the first bond that you have? Regular bond, zero coupon bond, perpetual bond. Am I right? Regular bond, the value will be present value of whatever coupon you get plus present value of redemption value. What about in case of zero coupon bond? It will be present value of only redemption value. Why? Because there is no coupon coming in that case. What about in case of perpetual bonds? In case of perpetual bond, it will be the present value of coupons forever. Okay, take a minute, write this down. I hope you are all comfortable with the pace, friends. Should I increase the pace or decrease the pace? Please give me a feedback. Accordingly, we can work it out. Thank you, Durga Prasad. Keep on messaging. Keep on chatting. Keep on talking also there because that's the only way you will be getting the active learning effect. So in the same 3 days, you will learn more if you keep on talking because actively you're engaging your senses into this. Fantastic. Everybody is comfortable. Let us go to the next part now. Perfect. So we learned about what is the value of a bond. Everyone clear? Now we will see how to find out the present value of perpetuity. Friends, why are you studying so hard to become a CA? Let's go to the bottom line. Why do you want to become a CA? To make money. Now let me ask you the next question. Do you want to make money by working your entire life, or do you want to make money while you are sleeping? Deep down, everybody will say, I wish I want to make money by sleeping, but it is not practically possible. That is the reason you are all working. Many of you have got big bucket lists. You want to travel around the world, watch movies, celebrate with your friends, but what's happening? You all are getting stuck with working because you want to make money. You have to take care of your EMI, take care of your family commitments, etc. What if I tell you, after you become a CA, if you plan your funds properly, you will be able to earn money every year without even working? That's what we call it as financially independent. Is this possible? Yes, but it's not immediately possible because you will have to invest some money, and one of the best places to invest is mutual funds, friends. I have researched a lot on multiple areas. Mutual funds provide you the best because mutual funds are diversified. You have an expert handling the money, so there is a very less chance that you will lose out on the money. So, if you can somehow work hard, slog hard, get the increment, save some money, and if you can invest 2 crore in a mutual fund, okay, you can take 10 years of your life, 15 years of your life, work extra hard, and if you make it up also, once you invest 2 crore, mutual funds will give you a long term assured return of 12%. Okay, not only that, apart from giving you 12%, let us say that there is an overall growth rate of 5% that is happening everywhere. Okay, so considering this, you will make how much is 2 crore into 12%? You will earn around 24 lakhs per year. Okay, let me for simplicity purpose keep the growth rate at 6%. Okay, so if you are making 24 lakhs from this, I'll show you in a fresh page. Year 1, if you invest 200 lakhs, you get 12%, that is you get 24 lakhs. You can invest half of this, you can spend. So 12 lakhs you can spend every year. All right, you can spend every year. Still you will have a closing balance of 212 lakhs. Next year your opening balance will be how much? 212 into 12%. You will get 25.44. Of this, half you can spend the next year. So next year, along with inflation, you can spend 12.72 lakhs and your closing balance will be 224.72. Like this, friends, you will keep on getting 12 lakh along with I think the growth rate is how much, friends, over here? 6% growth every year forever. Every year forever. Now, friends, I'll tell you how I got this answer. That's because we have taken a cash flow of divided by discount factor minus growth. This is the formula for perpetuity. So, if you want to generate 12 lakh every year, mutual fund is giving you 12%. You're looking for a growth rate of 6%. You will get the answer as how much? 200 lakhs. So that means by investing 200 lakhs, you can earn 12 lakhs along with 6% inflation every year. So let us assume you are not looking at 12 lakhs. You want to make 15 lakhs per year. What will you do? You just rework 15 divided by 12% minus 6%. Now tell me what answer do you get over there? 2.5 crore. So if you put in 2.5 crore, you can earn 15 lakhs every year along with 6% inflation forever. So that way you can sleep peacefully. So this is the formula for perpetuity. Can you quickly scribble this down in your books, friends? All right. So I believe you are clear with the concept of perpetuity also. Correct? Fine. So when you talk about bonds, The formula for perpetuity will be, as I told you, cash flow divided by discount factor minus growth, or it will be coupon divided by yield. That's what we call to the investor's expectation minus growth. Normally, friends, bonds don't have a growth. So it will be only coupon divided by yield, because growth is turning out to be how much? 0%. Okay. So I'll just quickly revise what we learned now. Value of any asset is nothing but present value of future cash flows. Regular bond is okay. Zero coupon bond is okay. When it comes to a perpetual bond, the formula will be coupon amount divided by yield. Are you all clear with this part now? Now we go to the next concept, which is yield. Yield means bondholders' expectation. Okay. Or friends, we have multiple terminologies here. One is the discounting factor. Other one is KE. Next one is KD. The last one is WACC. Discount factor means investor's expectation. If you are an investor, you can put the money in bond, or you can put your money in father's business. Had I put my money in bond, I will get over there 10% return. If I put this money in my father's business, father is giving me 13%. Will you put the money in the bond? The answer is no. You will not put. Why? Father is giving me more. Now let us assume father is giving you only 7%. Bond is giving you 10%. Will you put your money in the bond then? Yes, you will put the money in the bond. So friends, ideally what they say is that you have to check with your opportunity cost. So one example of opportunity cost is what? It is the money that you put in your father's business. Are you all clear so far now? All right. Fine, friends. So I believe you are all clear with this part. Investors' expectation. KE is what we call it as equity holders' expectation. KD is called as debt holders' expectation. WACC is called as overall investors' expectation. Take a minute, quickly write down this, then we will go to the next part. So every chapter will spend 1 hour on the concept and remaining hours on solving the questions. Okay. Whatever thoughts about these keep coming, keep messaging. That way you will be very, very active. Keep on talking to yourself also. We will do an active learning process. Okay? Friends, what do you mean by active learning versus passive learning? Do you remember the poem Twinkle, Twinkle, Little Star? When did you learn this poem? You learned this in your kindergarten. Now, if I ask you some question about trigonometry that you learned in your 8th standard or 7th standard, do you remember this? No, but you remember the poem which you learned even when you were much more smaller. How is that? That is because of active learning. How did you learn Twinkle, Twinkle, Little Star? Your teacher will tell you, stand up. You will all stand up. Then the teacher will tell, say, twinkle, twinkle, little star. What will you do? You will say, twinkle, twinkle, little star. Then you will come back home and tell, Mummy, I learned a new poem. Which poem? Twinkle, twinkle, little star. But by saying it again and again and again, you create an active learning process, and these thoughts, they get embedded in your mind. How did you learn trigonometry? You sat in a place, took a book, silently read through it, wrote something, finished it off. It never stays in your mind. Friends, as a CA final student, if you want to learn things actively, either talk or keep on writing or keep on drawing certain pictures over there. Active learning is what is required over here, friends. Okay? Yes. Nikita, your doubt is investors' expectation and inflation rate is same. No, it will not be same. Inflation always will be lesser than the investor's expectation. Why? Because investor will expect more than what the inflation rate is there until and unless the market goes negative, like COVID, etc. All right, perfect. Can I go to the next part now, friends? Ready? Okay, so we learned about yield also. Now, friends, when we learn about yield, there are three types of bonds. One is called as a regular bond. Other one is what we call it as a zero coupon bond. And the last one is what? It is a perpetual bond. Am I right? Okay. Now let's talk about regular bond. So when you talk about regular bond, here the formula can be coupon amount plus redemption value minus issue price divided by life whole divided by redemption value plus issue price divided by 2. Okay, so this is basically a formula that you learned in your CA interlevel also. After you did this, once you get this answer over here, next you can also use interpolation or IRR method. I think once we work out a question, you will become more clear about how this works. All right. IRR is another way how we can work out this one particular area. Everybody clear with this part? When you go for zero coupon bond, you have two methods. One is called as bond equivalent yield. Other one is called as effective annual return. Friends, all these formulas have logic. If you go to the concept videos, I'll share that link with you now. If you go to the concept videos, you get detailed concept. In this 25-hour marathon, it will be difficult for me to cover those concepts. So here the formula will be discount amount divided by current market price. Here the formula will be 1 plus whatever bond equivalent yield you got whole power n minus 1. For perpetual bond, we already learned it will be coupon amount divided by yield. Can you quickly write down this in your books, friends? YouTube chat is crowning some people as number one, number two, number three. What is that based on? Is it based on the messages that you send? Or is it based on some other criteria? Mary, you are number one. Megha, you are number two. Durga Prasad, you are number three. Congratulations. I don't know what are the criteria though. Fantastic. Good to know that. Okay. Keep on messaging, friends. Okay. Great. All right. Are you all done writing till here in your books now? Fantastic. So, friends, now I'll just show you from where you can get the free concept videos. Just visit my website. See, the moment you Google it, it's by itself giving you all these videos. You just have to visit my website. After you come here, you click on AFM free concept videos. Okay. So when you click here, you have all the things coming in. Friends, I'm revamping the whole website. That SFM has to be changed. It will be revamped in the next 1 or 2 months. Okay. Now here, if you click on, let's say, bond valuation. Okay. When you come down, meaning of bond valuation. Yield, first three formulas, logic. Logic of yield to maturity. Logic of average duration. Friends, all the logics are available over here. So it will become very, very easy for you to learn these things on your own. Everybody clear with this part now? Perfect. Perfect, friends. So I hope all of you are clear with this part. So we have learned regular bond. We have learned zero coupon bond. We have also learned what? Perpetual bond. Okay. Can I go to the next part now? Okay. After we learned these three things, I'll just teach you the next concept, next important concept, average duration. The logic of average duration is within how many years will I get my money back? That is what they are trying to answer using this question, average duration. Average duration can either be done using the table method or it can be done using the formula method. Everybody clear? Table method I'll show you when we do a problem. Formula method goes like this. 1 plus y divided by y minus 1 plus y plus n into c minus y divided by c into 1 plus y whole power n minus 1 plus y. Why such a useless formula, friends? You have in total 4 useless formulas. One is this, second one is the beta formula, third one is Black-Scholes model, fourth one is there in the chapter of security analysis. Apart from these 4, all the other formulas I can logically explain to you. But these 4 deadly formulas, the only way to remember is investing 5 minutes of your life for each of this formula. So in this 5 minutes, you have to write down this formula 10 times. No other way of. Once you write down, it gets in your head. Write down in the exam, finish it off. Everybody clear? Perfect. Now, can I go to the next part? Okay, take a minute, write it down. I hope audio, video, everything is clear, friends. Perfect. So we learned about average duration also. Then we have to learn about something called as volatility. The formula for volatility is duration divided by 1 plus yield. So when you do this, we get a percentage, or the logic of this percentage is for every 1% change in yield, what is the change in price? All this we will learn it effectively very soon, friends. All right. Yeah, please quickly write down this. Fantastic. Perfect. Can I now go to the next part? I think we learned the major part. Next one is convexity. I don't think I can teach you convexity like this. We'll start cracking questions now. All right. Are you all ready to crack questions, friends? Type a yes in the chat box. Fantastic, friends. Now, in order to view this question, okay, if you are already my past student, you will be knowing how to access this book. It's there in your batches of the respective class, wherever you attended. If you are not getting it, just WhatsApp the helpline, they will arrange it for you, okay? Other people, I think I showed you how to go and purchase this one. Price, I told you, please put the coupon code and you can buy it, all right? So that way it will become very easy for you. This has been created separately for all of you so that you can use it. Okay, the coupon code will expire after some 50 people who buy that book. All right, 50 or 100, I don't exactly remember. Once that's over, it will be expired automatically. Now, friends, here let's start with the questions now. Question number 1, this comes on page number. We are doing the practice questions, okay? It is coming on page number 4.A.50. Let's start with an easy question. Then we will go to the advanced level question. Okay. Are you ready? Question number 1, page number 4.A.50. Let's do this together now. Okay. So 10% Government of India bonds are having a 5 years to maturity. So friends, what I'll do over here is I'll write down working note number 1, basic data. Okay. Every question will start with basic data. So here they have given the coupon rate as how much percentage? 10%. So coupon rate 10%. Life of the bond is how many years? 5 years. Point number C, maturity value is how much? 10,000. All right. Now they are telling, find out the value of the bond if the desired yield is how much percentage, friends? 8%. Everyone tell me, value of a bond is nothing but present value of future cash flows. So I'll write down working note number 2, value of a bond. So value of a bond, I'll write down a table here, cash flow, discount factor, discounted cash flow. So now I'll put year 1 to 5 at the end of year 5. All right. So year 1 to 5, you have a coupon rate of 10%. So can you tell me how much is going to be your coupon amount over here? Is it turning out to be 1,000? Correct. At the end of year 5, it will be how much? 10,000. What is the yield that they have told in the question? 8%. 8%. Everybody clear with this part? So when you do it at 8%, let us see what will be the answer you will get. First, we need to take the PV annuity factor. Do you know how to take a PV annuity factor, friends? In the calculator, there is a shortcut method. If you don't know, let me know. All right. When you did like this, what is the price of the bond that I got over here? 10,800, or value of a bond is nothing but 10,800 rupees. Can you write down this in your books now quickly? Yeah, you can have a rounding of Durga Prasad, no worries at all. Okay. Okay, now this is a question what everybody asked me. How many decimals should I take? Normal cases, 2 decimals. All right. In questions like Forex, etc., where the question itself is having 4 decimals or 5 decimals, go by that number of decimals. All right. Perfect. So friends, this was an easy question. I started off with one easy one. Now let's go to the next one. So I think you got the answer as 10,800 approximately. Now they are telling if the bond is traded at 11,500. So I'll write down the next one. Action to be taken. Okay. So here I'll write down point number A. Actual market price. Everyone tell me what is the actual market price? Is it 11,500? Point number B, theoretical price. So tell me friends, what is the theoretical price that you get over here? Is it turning out to be 10,800? So now tell me, is it undervalued or overvalued? Your status will be price should be 10,800, but now it is 11,500. So it is what? It is overvalued. And since it is overvalued, what action will you take over here? Will you buy or will you sell? You will sell. Everybody clear with this part? So we are done with question number 1. Can I go to the next question now? Yes. Let's go to the next question. Let's do a couple of easy questions, friends. Get a grip and go to the advanced level questions. Okay. Now this is a question on zero coupon bond. Again, these are all steady material questions. Okay. This might look easy, but these are all steady material questions. Ready? All right. Question number 2. Working note number 1. Basic data. Point number 8. X Limited issued 1 lakh rupees bond. So what is the face value that you get over here? 1 lakh. Life, 5 years. All right. And they have told the maturity, yield to maturity is how much? 11%. 11%. What is the current value of the bond? If the bond is traded at 74,700, what will you do? If the bond is priced at 55,000, what will you do? Come on, again an easy question. Value of a bond is nothing but present value of future cash flows. Am I right? Yes. So again, it will be 1 to 5 at the end of year 5. Cash flow will be 1 lakh. Here you have a coupon. Have they given a coupon rate? No, it's a zero coupon bond. Okay. So friends, what will happen? This will become 0. Discounting factor 11%. 0.593. This is not relevant. So I think you'll get the number as 59,300 over here. Perfect. Now they are asking you if the actual price is 74,700 or if the actual price is 55,000. So please interact and tell me, friends, if the actual price is 74,700 means it should be 59,300, but the actual price is 74,700. Is it undervalued or overvalued? Overvalued. Will you buy or will you sell? You will sell. What about in this case? It will be undervalued. Hence, what will you do? You will buy. Quickly write down, then we go to the next question. All right. Fantastic, friends. I hope you're all comfortable with the session. Yeah, let's go to the next question now. Exactly, sell and buy. We got the right answer. Okay, this is a good question. Let's do this question now. Question number 3. This came in exam also, and it's a slightly different question. Question number 3. Working note number 1. Basic data. Now, M has to make a payment on 31/2001. So I'll write down point number A. Repayment date is 31/2001. All right. Yes. Now, how much money he has to pay? Amount to pay. Does he have to pay 80 lakhs over here? Correct. It has surplus cash today. Today's date is what? 31st October 2000. 31st October 2000. It has decided to invest the surplus funds in bank. So the extra money in bank in a scheme that is offering them a yield of how much percentage, friends? Yield of 8%. How much money should you invest now? Tell me, friends, how do you do this now? There are two ways of doing it. One, we can use a simple X method and we can do it. So X method means amount to be invested today will be X plus this X you are investing at how much percentage, friends? 8% for how many days now? So from 31st October, you have 30 days in November, 31 days in December, and 30 days in January. So it will be 30 November, 31 plus 30. You have 91 days. So this into 91 divided by 365. Has the question told 1 year is 360 days? No, right? This should be equal to how much, friends? This should be equal to 80 lakhs. So once I solve this also, I will get the answer. So that will be X plus 0.0199x is equal to 80 lakhs or 1.0199x is equal to 80 lakhs. Therefore, what will be the value of x now? Do I get the answer as 78 lakh 43,906? Everybody clear with the first methodology? Take a minute, quickly write this down. All right. Can I go to the next part now? Okay. So that is method number one. Method number two is what we have already learned, friends. Value of any asset is nothing but it is the present value of future cash flows. Okay. So when I say present value of future cash flows, how do we do that? Here, cash flow, discount factor, discounted cash flow. So here what happens at the end of the period, I should get how much? 80 lakhs. Now what is the PV yield they have told? 8%. But 8% is for 1 year. We should take 8 into 91 divided by 365. So that turns out to be 1.994 percentage. So now when you take this kind of a number, 1 divided by 1.01994 when you do, I'll get 0.9804. So now when I multiply this with 80 lakhs, I'll get the answer as 78 lakh 43,599. Please cross check. Almost the same, little deviation, that is rounding off error. And that's absolutely okay from exam point of view. You will not lose marks for this. Okay. Can you quickly write down this also in your books? With this, we are done with this question also. Can you quickly write? All right. Can I go to the next question now? Now that we have done some easy questions, let us go to some interesting ones. This is also easy. You can do this yourself. This is also easy. Okay, this is another good question. Question number 6. Let us do question number 6 now. Okay, so here you have a lot of data given. So as I told you, always we'll write down the entire numbers in the basic data. All right. So working note number 1, basic data. All right. So here they have given you the issue price 97,350. 97,350, and the face value is how much? 1 lakh. Face value is 1 lakh. Maturity period is how much? 3 months. Brokerage 0.125% for 3 months. What next have they given? Rating charges 0.5% per annum. And then they have given you the stamp duty, which is 0.125 percentage for how many months? For 3 months. Everybody clear with this part now? From this, they are asking you what is the effective interest rate per annum. Friends, first thing, they have an issue price over here and they have a face value. So basically, when you have an issue price and you have a face value, from this, from what I understand, they have not given any coupon rate separately, correct? So what type of a bond is this one, friends? Can you tell me? This is a zero coupon bond. So in a zero coupon bond, how do you find out the yield? I can either use bond equivalent yield or I can use effective annual return. Normally from exam point of view, we solve it using bond equivalent yield. All right. So I'll go to the next part. I'll write down the next working note. Bond equivalent yield. So what's the formula for bond equivalent yield, friends? Discount amount divided by current market price, correct? So here it will be 1 lakh minus 97,350, that is 2650, divided by the current market price. What is the current market price? 97,350. Do you get the answer as 2.72 percentage over here? Fine. Once you get this answer, then we will go and find out the effective interest per annum. How we do this is, you already got 2.72% plus, sorry, this is for what period? I need to convert this into 1 year. That's for 3 months, right? So into 12 by 3 I have to do. Do I get the answer as 10.88 percentage, friends? Correct? Okay. So let me write down in a much more neater manner now. 10.88%. So I'll just come down. Point number A, bond equivalent yield, that we got it as 10.88% per annum. Point number B, you have over here brokerage 0.125. So when you take 0.125 into 12 by 3, you get another 0.5 percentage. Everybody clear with this part? Next one, rating charges is already given on a per annum basis. So I'll just take it just like that. %0.5. Next one is what? Stamp duty 0.125%. That will be 0.125 into what? 12 divided by 3. Again, that is 0.5. So when I add up all these things, what is the answer I'll get over here? Do I get the answer as 12.38 percentage? This will be my effective interest per annum. Can you quickly write down this in your books, friends? This is the basic data. Fantastic. Please write down this now. These are all exam questions, okay? What we are doing is all exam questions. So Mastery Book has only compiled all the examination questions together. Fantastic. Are you all done till here? Perfect. So friends, we are done with this question also. Are you all comfortable so far, friends? Just a moment. Okay. Yes, friends. So we are done with this question also. Now, friends, I want you to work out one question yourself. Okay. Question number 7. It's a very simple question. I want you to do it yourself first. Then we will discuss and do it together. All right. 5 years the life. Coupon rate is how much percentage? 8 percentage. Maturity value is how much? 1000. Current selling price 925. They are asking you to find out the yield to maturity. Everyone tell me what is the formula for yield to maturity? Coupon amount plus redemption value minus issue price divided by life whole divided by redemption value plus issue price divided by 2. Can you quickly take 5 minutes and do this on your own, friends? Yes, friends, shall we quickly discuss it together now? So here, live 5 years, coupon rate is 8 percentage. Am I right? Minute. Yeah. Coupon rate is 8 percentage, maturity value 1000, issue price is how much? 925. And when you do it this way, hold on, you get coupon amount, redemption value minus issue price. You get the answer as how much over here, friends? 9.87. Fantastic. Are you all comfortable so far, friends? So we are done with this question also. Okay. Perfect. This is an easy question. We'll ignore that. Friends, you can do all these questions yourself. Okay, they are all very easy. Yes, this is a good question. All right, friends, let us do this question now. This is a very good question. This question is having a variable coupon rate. So let's write down the basic data. Working note number 1, basic data. So here I'll write down point number A, whatever is my face value. So my face value is equal to 100. Point number 2, life. Life is equal to 10 years. And they have given you a different coupon rate. So year 1 to 4, your coupon rate turns out to be how much percentage? 9 percentage. Year 5 to 8, your coupon rate turns out to be how much? 10 percentage. Then year 9 to 10, your coupon rate turns out to be how much? It turns out to be 14 percentage. So friends, as your years changes, your compounding factor is also changing. So when it comes in this manner, ideally to solve this question, we can either use the table method or there is also the formula method which can be actually used over here. Okay, let's just go down. Please write down till here first. All right, I'm going to the next page now. Okay, now, so when you come down, they have given you the face value term. They have given you the market rate for the similar debenture is 15, but X Limited wants to price it in a way that the yield can be 16%. So what is the relevant yield for us? Market rate is actually what we should take, but here since he wants to price it with 16, we will stick to 16. All right. X also proposes to redeem the bond at 5% premium on maturity. So what will be your redemption value? Everyone tell me. Your redemption value will be 105. Everybody clear with this part now? Okay. So considering this, now when you come down, they have given you the face value, life, all the datas are given over here. Okay. Now, how they are going to do it is, first year 1 to 4, you have a cash flow of 9. Okay. Year 5 to 8, your coupon rate will turn out to be how much? 10. Year 9 to 10, it will turn out to be 14. And at the end of year 5, it will be 105. So the PV factor is where you have to play around now, because first one, you will have to take the PV factor up to 4 year, it's okay. How do you take for year 5 to 8? I'll just explain that to you. You should first take from year 1 to 8. So how do you take from year 1 to 8? 1 divided by 1.16. So you get the answer as 4.34 minus already how much has come till here? Is it 2.798? So you get the difference. The difference is 1.55 approximately. That's how you get the number. So friends, can you take 1 minute and quickly write down this in your books now? Yeah. Okay, Durga Prasad, I missed one of your messages. So you're saying that If they don't talk about days or months, can we take months to calculate? Yes, you can do it that way. Nothing wrong. All right, friends. I believe you are all done with this part. So we are done with this question also. Perfect. Right, friends. Can we check the next question now? Okay, next is a very, very tricky problem. I think we'll first continue with the conceptual flow, then we'll come back to question number 10. Remind me, we'll do question number 10. Okay, 10 is a very, very good question. Okay, right. These are all similar type problems. It's all on bond refunding. I need to explain you the concept of bond refunding, then we can do it. These are all on bond refunding. Okay, let's do a question on duration of the bond now. Question number 14, duration. Shall we begin now? Everyone write down question number 14. Working note number 1. Basic data. Find the current market price of the bond whose face value is 100. Sorry, face value is not 100, it is 1 lakh. Face value 1 lakh. Life, how many years? 6 years. And then you have YTM at how much percentage? 16 percentage. All right. They have given you the duration is also given in the question. So friends, this question is actually a reverse working. They have given you the duration. What is the duration given over here? 4.3202. So already duration is given, and from this they want you to find out what is the coupon rate. Friends, I told you there are two methods. One is table method and the other one is what? Formula method. Here we cannot use table method. Okay. So we'll do this using formula method, and I have already given you the formula. Shall we write down the formula once again now? Duration is equal to 1 plus y divided by y minus 1 plus y plus n into c minus y divided by c into 1 plus y whole power n minus 1 plus y. So when I put it this way, I think we know the yield. What is the yield? 16%. So 1.16 divided by 0.16. What's the duration? 4.3202. Minus 1 plus y plus life. What is the life? 6 into c we don't know, minus 0.16 whole divided by c into 1.16 whole power 6. That is 2.436 minus 1. I think they have given the value over here. 2.4364. Whatever value they have given in the table, we'll take that value because otherwise rounding off error will come. Plus 0.16. This is the formula. Let us try solving it now. 4.3202 is equal to 7.25 minus 1.16 plus 6c minus 0.96 whole divided by 2.4364c minus c plus 0.16. I hope I have done it correctly. Friends, please pray to God I get the right answer. C into 1 plus y whole power n minus 1. Yeah, correct. Then we multiply with this, correct. Plus y, correct. All right, let's continue now. 4.3202 is equal to 7.25 minus, what is 1.16 minus 0.96? You get 0.20 plus 6c divided by, what is 2.4364c minus 1c will be 1.4364c plus 0.16. Am I right? Whew. So now what do we do next? I think I'll do one thing. I'll put it on the next spot. So 0.20 plus 6c divided by 1.4364c plus 0.16 is equal to 7.25 minus 4.3202. Beautiful question, friends. 2.9298. Now I will do cross multiplication. So 0.20 plus 6c is equal to, what is 2.9298 into 1.4364? That is 4.2083c plus 0.468768. Now, I think now it's easy. So what I'll do is I'll put this on this side. So 6 minus 4.2083 will be 1.7917c is equal to, I'll take this on the other side, 0.468768 minus zero point 0.2 will be 0.268768. Therefore, C is equal to 0.268768 divided by 1.7917. Am I right? Correct. 0.268768 divided by 1.7917 in percentage will be 15 percentage. Beautiful question, friends. Let me cross check the answer here. 15 percentage. Beautiful question, friends. Take some time, enjoy the beauty of this question, and do this question now on your own. Mary, you got the answer yourself. That's amazing speed, Mary. Keep it up. Okay. I'm giving you a little bit time because this question was a little bit difficult to absorb. All right, friends. So we are done with this question also. Oh, there is one more part of this question, is it? Fine, friends. Question 14 has one more part. Let us do that part. They're asking you to find out the current market price. Everyone tell me price of a bond is nothing but present value of future cash flows. So here it's been solved very easily. You have a coupon of 15,000 for 6 years, and at the end of the 6th year you're getting 1 lakh rupees. Then there's a small typing error over here which needs to be corrected. It is not 10 lakhs, it is 1 lakh. 1 0 has become extra. Please just strike that off. Okay, right. I will update this saved part over there in the drive. I will update it. Okay, right. So friends, it is 1 lakh. So you get the price as how much? 96,310. Is everybody clear with this part now? Yes. So we are done completely with question number 14. Okay. Can I go to the next one now? This is easy. I don't need to waste time on this. This is easy. Percentage downside risk, we'll do it afterwards. We'll do this once we are done with the concept that we are doing now. Okay. Yeah. I think we can do one more question on duration of the bond. Okay. All right, friends. Let us take question number 18 now. In this, we'll write down working note number 1, basic data. Basic data. So first I'll write down the face value. Face value is 1000. Then you have the coupon rate, 16 percentage. Life is how many years? 6 years. Redemption value 1000. Okay, then you have YTM 17%. YTM 17%. They're asking you to find out the current market price, the duration of the bond, and the volatility of this bond is what they are asking. So friends, as I told you, we can find out the duration using two methods. One is the table method, and the other method is what we call it as the formula method. All right. So friends, table method, I will just explain to you by using the table because that's easier for me to do it. Okay. Right. So first they are asking you to find out the current market price, duration, and volatility. Okay. Yes. Let's come down. Okay, hold on. 964. Fine. Friends, here itself you get the price of the bond also. This is the table format for working out the duration of the bond. Year, cash flow, discount factor, discounted cash flow. After you get the discounted cash flow, they take the proportion of the bond value. So, for example, here if you see, I got the price as 136. Here it is 964. So when I take the proportion, I get the proportion as how much? 0.142. Or the logic is 14.2% of the cash flow occurs in the first year. So now this into 1 when I do, I get the average duration over here as how much? 0.142 year. Second one, the logic is 12% of the cash flow is happening in which year? Second year. So the average of this is how much? 0.246 year. Like this, they will take every year, and at the end, you get the answer as how much? 4.247. Or the logic is I get back my money on an average in how many years? 4.24 years. Can you please quickly write down this in your books now? All right, friends. I believe you're all done writing till here in your books now. Okay. Friends, once you do it using the table method, what is the second method that we are having right now? The second method is called as the formula method. Everyone tell me what is the table, what is the method, what is the formula that has to be used. It is not done here. I will do it using formula method, and then we'll pray to God that whatever answer we got over here, we should get the same answer using what method also? Formula method also. Are you ready? Working note number 3, formula method. So what's the formula method? Everyone tell me. 1 plus y divided by y minus 1 plus y plus n into c minus y divided by c into 1 plus y whole power n plus y. So what's the yield in this question, friends? Can you tell me? 17%. So 1.17 divided by 0.17 minus 1.17 plus what's the life? 6 years. 6 into what's the coupon rate? I think it's 16%, right? 0.16 minus 0.17 whole divided by C into 1.17 whole power 6, 1 plus y whole power n minus 1 plus y. I made a mistake in the formula. Minus 1 plus y. Am I right? Okay. So this minus 1 plus y. Okay. So when I do this, let me just work it out now. So how much is 1.17 divided by 0.17? Is it turning out to be 6.88 minus, do you get the answer as 1.11 divided by 0.2504 plus 0.17? So 6.88 minus 0.4204, 0.6896. 6.19. I've made some mistake, friends. Where did I go wrong? Hold on. I made some mistake somewhere. We'll just cross check that now. 1 minute. 1.17, 2.56 minus 1 into 0.16 plus 0.17 is 0.4204. Okay, so that part looks to be correct. I think 0.4204. And upstairs I had 1.11, correct? Okay, 2.64. 6.88 minus 2.64. 4.24 years. Is that the answer that you got earlier? I made a small arithmetic error. Yes, the answer is correct, friends. Hence proven that whether you use the table method or the formula method, your answer will remain the same. Take a minute, write down, then we go to the next question. Yes, friends. Are you all done writing till here in your books? So we are done with the first part of the question where we got the duration. Now let's read the second part. Current market price. Price of the bond is nothing but present value of future cash flows. Here we already got the answer as how much? 964.4. So that part is also clear. Now let's read the next part of the question. Calculate the price and the volatility of the bond. Everyone tell me what is the formula for volatility? This is nothing but duration divided by 1 plus yield. Correct? So what's the duration that you have in mind in this question? 4.24 divided by I think 1.17. Do you get the answer as 3.62 percentage? Or the logic is for every 1% change in yield, price will change by how much percentage, friends? 3.62 percentage. Fantastic, friends. Everybody clear with this part? So once you are done that, they're asking you what will be the price if the yield is going to increase by 75 basis points. So I'll write down the next heading, revised price. So if yield increase by 0.75%, friends, 75 basis points is what? 0.75%. Price will fall down by how much, friends? 3.62 into 0.75. So that is 2.715 percentage. Therefore, your revised price will be how much, friends? Will be, what is the current price? Current price is 964. Yeah, 964.4 minus 2.715%. Do you get the answer as 938.20 rupees? That's it. So we are done with this question. Can you write down this in your books now? Yes, friends, I believe you're all done writing till here in your books now. Perfect. So I think we are done with this question also. Shall we check it? Yeah, 938.14. So we are done with this question, question number 18. Perfect, friends. So we are done with this. Let's go to the next one. I think we have done quite a lot of good questions now. This is a very good question. Shall we do this now? Question number 19. Working note number 1. Basic data. Can you please copy down this full table in your books? This is a very, very good question. Little illogical, but a very good question. Hi Ajay, for FM also we are planning the same thing. It will happen very, very soon. Please WhatsApp the helpline number that you will get it from the description. Okay, I'll keep you in touch with this. Please write down the basic data on your own, friends. Yes, friends, I believe you have put up this data. Now they are asking you that Mr. A will need 1 lakh rupees after how many years? 2 years. He wants to make a one-time investment now. So considering this data, he has given you details about bond X and bond Y. So friends, even before we proceed with the question, what the first thing that we need to do is we need to find out the duration of bond X and then we need to find out the duration of bond Y. Okay. So first you write down the duration of bond X. Do it using table method. But friends, let me tell you using common sense. If the life is 1 year, then duration of the bond will also be 1 year because it cannot go lesser than that. Correct. So for X, you get the duration of bond as how much? 1. Same way you do it for bond Y also. So can you please try doing these two on your own now? Duration of X, duration of Y. All right, friends. Did you get the duration of bond X as 1? And did you get the duration of bond Y as 3.53563? Correct? Now I'll do the next part. What is the average duration during which he needs the money back? He needs the money back in 2 years. So, in order to get the money in 2 years, we have two bonds now. First bond has a life of 1 year. So 1 into proportion in the first bond plus second bond has a duration of how much, friends? 3.563. 3.563 into what? Into 1 minus x. So once you put it this way, the formula would be 2 is equal to x plus 3.563 minus 3.563x. Therefore, 2 is equal to, now let me take it on the other side now. So I'll put it, I'll do a, changing the equation. So it'll be 3.563 minus 2 will be what? 1.563 is equal to, this will go on the other side. So it will be equal to 2.563x. Therefore, x is equal to 1.563 divided by 2.563. Do you get the answer as 60.98 or approximately 61 percentage over here, friends? Correct. So if weight of x is 61%, what will be the weight of y? 100 minus 61. That's equal to how much? 39 percentage. Everybody clear with this part now? So now what I'll do is, I'll just write down amount in 2 years. What is the amount required in 2 years? 1 lakh. I will put the present value factor, that is 0.10% second year, 0.909, 0.826. So what is the amount to invest now? Will that turn out to be 82,600? Out of this now, if I'm not wrong, we have to put 61% in bond X, 39% is required in what? Bond Y. Am I right? Okay. So now tell me how much is 182,600 into 61 percentage? Is it 50,386? Is this 32,214? Am I right? All right. So friends, once you get these numbers, what is the price of bond X? Let's go and check. Price of bond X is 972.63. Price of bond Y is 936.52. So now tell me, what is 5386 divided by 972.63? Do you get the answer as 51.8280 bonds, or in practice we can buy how many bonds of bond X? 52 bonds. 32,214 divided by 936.52 will be 34.39, or that will be 34. Fantastic. Can you put this chart in your books, friends? You want to write down this first? Write down this. All right, friends. So I believe we are done writing this now in our books. So with this, friends, we are done with this question also. Fine. Friends, shall we take a break now? We have a few more questions to do with we'll be done with this with this chapter. But even before I do these questions, I need to teach you bond refunding also. Okay, so we have a few more questions to be done. With that, we'll be actually covering this entire chapter, friends. So I hope you are all comfortable and clear so far, friends. If yes, just I have a small request. One, please like this video, and if possible, please do subscribe to my channel. And three, if possible, please share it with your friends so that everyone can benefit from this. Because I strongly believe in only one thing: if only genuine student reference should bring students to my channel. So I request you all to please support me in this one particular part. Let's take a break now. Time is around 8:50 a.m. now. I'll take a break and we'll get back at 9:30 a.m. and we'll resume with our next session. Okay. Thank you so much, everyone. Have a good day. I'll see you after 40 minutes. Okay. I'll see you here itself. Thanks a lot. You all can leave. I'll just take 2 minutes to just check some settings over here, friends. Okay. All right. I think I'll have to sign off anyways. I'll sign off and see you soon. Thank you so much. Friends, I'm live. Are you able to see me? Please type a yes in the chat box, friends. Friends, I'm live. Are you able to see me? Yes, Manisha, Sarvamangala, good evening. Sorry, good morning. Good morning, Deepthi, Aishwarya. Perfect. Shall we begin off now, friends? Are you all ready? So, as we were doing, we were working out questions over here. I think we covered this question. 18 is covered, 19 is also covered. Let's do a few more questions and we can wrap up with this bond valuation and we can go to the next one. Audio, video, everything clear, right? Please confirm. The connection is good. Yes, it's all good, friends. Shall we begin now? Perfect, perfect. So let's take and do question number 20 now. Question number 20. Bond valuation chapter. All right. Wonderland Limited has an excess cash of how many lakhs over here? 20 lakhs. So as we always start, friends, what will be working note number one? Basic data. Am I right? So here has excess cash of how many lakhs? 20 lakhs. Excess cash 20 lakhs, which it wants to invest in short term marketable securities. So they want to invest this money in some short term securities. Expenses pertaining to investment is how much? 50,000. The securities invested will have a yield of how much percentage, friends? 9%. All right. As now they want to find out what is the period of investment so as to earn a pre-tax income of how much, friends? 5%. So I'll write down working note number two. Period to get Pre-tax income of how much percentage? 5%. Friends, now here, ideally, there are two interpretations to this question. That is the reason we are doing this question here now, friends. Interpretation number one is that on 20 lakh, you get 9% return. How much is that turning out to be? Do you get the answer as 1.80 lakhs? From this, you reduce 0.5 lakh as your expense. So when you do it like this, what is the answer you get over here? Do you get the answer as 1.3 lakhs? This is one way of doing it. The other way of doing it is you can take 20 lakh minus 50,000. That investment is directly reduced from the surplus cash. And then you multiply with what? With 5%, with 9%, sorry. So when you do like this, you get a different answer altogether. You will get the answer as 1.755 lakhs. Okay. Now let's see how your ICAI study material has actually solved this question. They have taken the data as 20 lakh into 9% into the period whatever is there. Then they have reduced the 50,000. Everybody clear with this part? So now what they have done over here is they have taken 20 lakh into 9% into some period of months minus 50,000 should give you a pre-tax return of how much percentage, friends? 5%. So how much is 20 lakh into 5 percentage? Is that turning out to be 1 lakh over here? So this should give you the answer as how much? 1 lakh. So when you solve this equation, you get the period as how much over here, friends? 10 months. Can you quickly write down till here in your books now? Yes, friends. Shall we continue now? I hope you are all clear so far. One moment. I believe you're all clear so far. Let me go to the next part now. So that is the first question. The second question is what is the minimum period for the company to break even its investment expenditure over time? So friends, what is the break even point? The break even point is the point at which your profit or loss will become zero. Am I right? So in that case, they have taken the same equation, but instead of putting 1 lakh over here, what have they put over here? They have put it as zero. So now when you're trying to break even, you can break even this in how many months, friends? 3.33 months. Okay. Can you please write down this and finish it off? We are done with this question now. All right. Shall I go to the next question now, friends? Are you done with question number 20? 20, are you done? Okay, 1 minute. 1 minute, friends. Okay, let me check. This question is easy. We have done a similar question earlier. 1 minute, 10 crore. Interest rate is 12.04%. Okay, easy one. Let's do it quickly. Are you ready? Yes, let's do it quickly. Question number 21. Working note number 1. basic data. So Z company has issued a commercial paper worth how many crores now? 10 crores. So I'll write down the value of commercial paper is equal to 10 crore. Okay, the date of issue is what? 16 Jan 2019. And the date of maturity is 17th April 2019. Number of days is how many days over here? 91 days. And what is the interest rate that you have over here? 12.04%. Everybody clear with this part? Now, friends, from this data, can we first find out the duration? So I'll write down point number F, duration. So what is the duration that we have? 16 Jan means 15 days in January, 28 days in February, 31 days in March, 17 days in April. Do I get the duration as 91 days? Okay. What is the effective interest rate that they have told over here? 12.04. So what is the interest rate for 91 days now? That will be 12.04% into 91 divided by 365. Do I get the answer as 3%? Friends, value of a bond is nothing but present value of future cash flows. What is the future cash flows over here? So the value will be 10 crore divided by 1.03. That's the present value factor, 1 divided by 1.03, correct? So do I get the answer as 9 crore 70 lakh or 9.7087 crore? That's it. We are done with this question. Shall we cross check the answer? Interest is reduced 9.708. Yes, we have got the same answer over here, friends. Write down and finish it off. We are done with this question also. Friends, these are all small questions, but all these have come in the exam. So it is having a lot of value in less time. All right. Fine, friends. Can I go to the next question now? Are you all done writing till here in your books? Wait, Mary, you have a doubt? How did I get 1.03? Mary, how do you find out the present value of 10%? PV factor for 10%? Do we do 1 divided by 1.1 and that's how we get 0.909? Exactly in the same way, if I want to take the PV factor for 3%, the formula will be 1 divided by 1.03. I'll get the number as 0.9708. Are you clear now, Mary? Okay. So I think we are clear with this part now. Shall I go to the next one? Yes. Even this question is over. Right? Next question is a question on repo rate. Repo and then you have a reverse repo. Friends, this is a very good question. Let us do this question together. Moment. Question number 22. 22, right? Yes. Working note number 1. Basic data. Okay. Friends, now here what is happening is Bank A is entering into a repo for 14 days with Bank B. So there are two banks over here. First one is Bank A. Second one is Bank B. So when they say that bank A is entering into a repo with bank B, it means bank A is going to receive a loan from bank B. That is the meaning of this question, friends. All right. What is the duration of the loan? 14 days is the duration. Okay. Now, what is the underlying security over here? The underlying security is what? 10% GOI bond. 10% GOI bond. Everybody clear with this part? Okay. Now, interest rate is how much percentage that they have told? Interest rate is 5.65 percentage. What is the face value of the bond? Is that turning out to be 8 crore? Correct. Assume the clean price. Now they have used a word called as clean price. Friends, clean price is nothing but it is the issue price. So the clean price is how much? Is it 99.42? Initial margin is how much? 2 percentage. Is how much? 2 percentage. And the days of accrued interest is how many days? 262 days. 262 days. Everybody clear with this part now, friends? So basically, what they're intending over here is that A is going to take a loan from bank B for a duration of 14 days, duration of 14 days, yes, at an interest rate of 5.65 percentage. But this is happening after 262 days. So if I draw another chart, okay, so this is, let me call it as day number 0. This is day number 262. All right. On this date, the clean price of the bond is how much? Is it turning out to be 99.42? Am I right? Now, they are going to borrow on this date. This is the borrowing date. And they are going to repay on this date. So I'll call this as the first leg. First leg is the word what they use, or this is the borrowing date. This is what they call it as the second leg. So this is what is the repayment date. Now friends, what exactly happens over here is 99.42 is the price on the first date, correct? Now with this 99.42 on 100 rupees face value, what is the coupon rate they have told on the bond? 10% into 262 divided by 360 when you do. So why am I doing into 262 divided by 360 is because that will help me to find out how much is my accrued coupon rate that is coming on this one particular part. All right. So I think I'll get the answer as 7.27 friends. Correct. Now tell me what is 99.42 plus 7.27. Do I get the answer as 106.9? Sorry, 106.70. This 106.70 is what we call it as the dirty price. Everybody clear with the word now? So there are two words over here. First word is what we call it as the clean price. The other word is what we call it as the dirty price. Why we call it as dirty price is because this is the price including the coupon that is accrued for how many days? 262 days. Okay. So once I get this, I'll just tell you how to do it. Now tell me, what is the face value of the bond that they have told in the question? Is it 8 crore? Face value per bond is how much? 100 rupees. From this, can I find out what will be the number of bonds? Do I get the answer as 8 lakh bonds? For each of the bond, the dirty price or the price including coupon is turning out to be how much? 106.7. Therefore, what will be the value of the bond? Does it turn out to be 853.60? On this value of the bond, they are taking a how much percent margin in the beginning, friends? They are taking a 2% margin over here, correct? So after the margin, I think you get the price as 836.52 lakhs. This is the amount of loan to be given. So 836.52 is the loan given today, plus they are going to charge you interest at the rate of how much percentage? 5.65 percentage, correct? So 836.52 into 5.65 percentage into 14 divided by 360. Can you tell me how much is that turning out to be? Is it 1.83? So when you add up this over here, 836.52 plus 1.83, you will have to pay how much money over here? 838.35. This is the logic of this entire thing. Sarvamangala, I have showed over here. How I got that is I reduced 2% from 853.6. I reduced 17.07 as the margin. That's how you get 836.52. All right. Yes. Can you please draw this diagram in your books now? Ramya, don't worry, I'll revise it. First, you write down. Are you all done drawing this diagram now? Can I go to the next page? Please write down this also in your books. It's a little tricky problem. Are you all done writing till here in your books now? Let me re-explain this whole question to you once again. Shall we do that now, friends? Okay, listen very carefully. So here what is happening is you have an initial issue price that is 99.42. That price is what we call it as the clean price. Along with this, the interest accrued for 262 days is turning out to be how much, friends? 7.27. So when you add up the clean price with the coupon rate, you get the closing price over here as 106.7. This is the price including what? Including coupon rate. Everybody clear with this part? Now, once you get this as the answer, what we do is we go to the next page. 8 lakh bonds are there. Every bond has a market value of 106.7. So the closing value becomes how much? 853.6. After you reduce the margin of 17.07, the loan to be given will turn out to be how much, friends? 836.52 lakhs. Are you all clear with this part now? All right. Fine, friends. So I believe you are all done, doing this particular part. Remya, are you clear now? So once you get that 836.52, you take it here, plus you take the interest. That's how you get 838. This is called as the first leg. This is called as the second leg. Take one more minute. Whatever doubts you have, you can ask me. All right, friends. So we are done with this question also. All right. Now, shall we go to the next question? This is a beautiful question which came in MTP RTP, but I have never come. But I want you to work out this question now. All right. Question number 23, bond valuation chapter, page number 4.A.76. Take 5 minutes. Try doing this yourself now. This is similar to the previous question on repo reverse report that we did. The only difference is that here they are giving you the first leg and the second leg, and they want you to work out in a backward manner. So take 2 minutes time, friends. Can you try doing it yourself now? All the best. Yes, friends. Shall we do it together? So what I will do now is I'll draw a diagram similar to this one so that it becomes easy for me to explain to you. All right. Now, friends, Bank BK has entered into a repo for how many days? 9 days, correct? 6% GOI bond for an amount of how many crore? 2 crores. So I'll just come to a fresh page. Face value is how much? 200 lakhs. Am I right? And the relevant details are given below. First leg is 200 lakh 6,750. 200 lakh 6,750. Second leg is 200 lakh 31,759. Everybody clear with this part? Initial margin is how much percentage? 1.25 percentage. So wait, face value is given. Total, I think face value per bond is supposed to be 100. So what is the number of bonds that I get over here? Number of bonds will be 2 lakh bonds. Am I right? After I get this, this is what I multiply with the dirty price. So after multiplying, what will I get? I'll get the market value of the bond. From this, I will reduce my initial margin. And that is how I get the loan to be given. Yes or no? This loan to be given is 200 lakh 6,750. Am I right? Now, from this, can I do a reverse working? So what have they told over here? Initial margin is 1.25 percentage. If this is 1.25 percentage, can I say the market value of the bond will be 98.75 percentage? Or wait, from 100, if you, sorry, this will be 98.75 percentage. And this one will turn out to be how much percentage, friends? 100 percentage. Am I right? So 200, 0.6750 divided by 98.75 percentage, you get the market value of the bond as 20 crore, no, 202 lakh 60,000. Reading pen means new findings. All right. Now, this divided by 2 lakh bond means I will get 101.3 over here as a dirty price. And my margin amount will be 202.6 into 1.25 percentage, that is 2,53,250. Everybody clear so far, right? So I'll come back in the diagram. Here it is 101.30. Here the clean price, have they given the clean price in the question? No, clean price is not given. Have they given after how many days they are giving the loan? Days of accrued interest is 240 days. So 100 into 6% into 240 divided by 360 is equal to, is it equal to 4? So if that is the case, I can do a reverse working now, friends, to find out my clean price. Do I get the answer as 97.3 will be my clean price. So how did I get this? 101.3 minus 4. Everybody clear with this part now? Beautiful question, friends. Now I can find out the interest portion. 231,759 minus 200,06,750. I'll get the interest as 25,009. How did I get this 25,009? We got it in 9 days time. Correct. So I'll take a fresh page. 200 lakh 6,750 into some percentage into 9 divided by 360 is equal to 25,009. Therefore, I will get this X percentage as how much, friends? It will be 5 percentage. Beautifulest question, friends. 5 percentage they got. 101.3 dirty price, 97.3 clean price. We have got the same answer. Write down and finish it off. Beautiful question. Yes, friends, are you all done writing till here in your books now? So we are done with this question now. All right. Shall I go to the next part now? Now, this question you can do it yourself. This is also a very easy problem, friends. You can do it yourself. Multiple coupon rates we have already covered. Okay. We need to do bond refunding is one part that is pending. Uh, the conversion premium will do it with share valuation. Okay. Right. So I think we can get into bond refunding question now. So first we learn the concept. So friends, next concept that we need to learn, bond refunding. So here basically what happens is, for example, if we have NHAI bonds, okay, this one bond, let us say, has some old bondholders, some old fellows are there. ₹100 crore is the face value, of which the coupon rate is 10%. All right, or we'll take it as 10%. Now, friends, what happens is the remaining life of this bond is turning out to be, let us say, 5 years. Fine. And the redemption value is the exactly the same value of 100 crore. Now, what has happened is suddenly COVID came and hit the market. Because COVID came and hit the market, the price of the market rate fell down. And now what has happened is there are some new bond holders who are available in the market who are willing to take the same thing at the rate of 7%. Life 5 years, and you have a redemption value of the same 100 crore itself. So now what NHAI bonds will do is it will receive 100 crore from the new bond holders, and what will it do? It will repay the 100 crore to the old bond holders. When they do like this, will the old bond holders be happy or will they be sad? The old bond holders will be a little upset in this case because they're losing out on the interest. So in order to make them happy, what NHI will do is it will pay them a call premium of, let us say, 5%. So that will be how many crore? 5 crore before tax. Everybody clear with this part now? Yes, perfect. So once you do this, automatically what will happen is that old bondholders will become happy because they are getting 5 crore extra. Can you please write down till here? Then I will show you the solution also. All right, friends. Shall we now do the remaining part now? So what happens in this case is we are just trying to check from NHAI point of view whether this bond refunding is feasible or not. So what we do is we do the NPV calculation. Working note number 1 will be called as the initial outlay. So here, what is your initial outlay? You receive 1 crore, 100 crore, you pay 100 crore. Are you making any extra payment over there? No. So that becomes zero. But you end up paying the call premium. Am I right? So how much is the call premium that is coming over here? Is it 5 crore? 5 crore is before tax. If 30% tax rate is there, you get the amount as how much, friends? 3.50 crore. Are you all clear with this part? Fine. So that is going to be your what? That is going to be your call premium. Apart from that, I think you don't have anything else that is coming in the beginning. So this is your initial outlay. Now I will write down working note number 2, which is your in between cash flow. Now here, what is the main in between cash flow? You have a savings in coupon. Earlier you were paying a coupon of 10, now you are paying only 7 on 100 crore. That is how much? 3 crore. 3 crore into 30% tax advantage will come in. So net effect is turning out to be how much? 2.1 crore. Third part is what we call it as your terminal cash flow. Okay, terminal cash flow. So what happens in case of terminal cash flow is that old bond I would have paid 100 crore. New bond also I have to pay 100 crore. So am I paying anything extra over here? No. So my terminal cash flow will become 0. Then we go to working note number 4, which is a discounting factor. So now tell me, how much is the discounting factor that you get over here? Do you get the new coupon rate is how much? 7%? This they take after tax. So I'll write down discount factor is after tax coupon rate. So I think that will turn out to be how much, friends? Do you get the answer as 4.9%? Correct? So once you get this answer, we will go and calculate the NPV. I'll draw a table here. Cash flow, discount factor, discounted cash flow. Year 0, what is the amount that you are paying for this new bond? 3.5. Year 1 to 5, what is the savings that you are making over here? 2.1. At the end of year 5, I think your savings is turning out to be 0, correct? Yes. So now I think with the discounting factor of 4.9 percentage, do you get the answer as 0.7872, not relevant, 4.34. So minus 3.5, 9.11, this is 0. Do you get the answer as 5.61 plus over here? So friends, since the NPV is positive, are we supposed to accept or reject? We should refund the bond. This is the concept of bond refunding, friends. A very, very important concept. Can you quickly just write this down in your books and finish it off? Yeah, Minu, we have already done that. 2.1 is after tax rate. We have done that over here, Minu. 3 crore was the money into 70% is how you got this number. So are you all clear with this part, friends? So we are clear with the concept of bond refunding. Now shall we do a question on this one, friends? All right. Let's go to the next question now. Let me take that question now. We have covered this chapter exhaustively, friends. Even though we got a short time, we have covered quite a lot of questions. Twelve is there. 10 is more easy to understand. We can, sorry, 11 is more easy to understand. 10 is a very, very nice and a tricky problem. Shall we do this? Okay. Question number 10, bond valuation. This is a question on refunding the bond. Are you all ready? Working note number 1, basic data. X Limited is contemplating to call 3 crore. So what's the face value of the bond? 3 crore. What's the life of the bond? 30 years. Face value 1000 rupees. Life 5 years. Coupon rate 14 percentage. Now, bond has a call price of 1140. So, call price, that means you're calling at a premium of how much, friends? 140 rupees. Call price of 1140 initially collected the proceeds of 2.91 crore. Initial proceeds 2.91 crore due to a discount of 30 rupees per bond. Shall we continue now? 30 rupees per bond. Initial floating cost was 3,60,000. Three lakh 60,000. Company intends to sell 3 crore 12% coupon rate. As of now, what's the coupon rate, friends? 14. But new bond is having 12% coupon rate, 25-year life. So what is the remaining life that you have over there now? 25 years. Everybody clear with this part? 25 years. And it proposes to sell the new bond at their par value of 1000. Par value of 1000. The estimated flotation cost is 4 lakh rupees. ₹4 lakh. Tax rate 40 percentage. tax rate 40%. After tax KD, after tax KD is how much? 8%. As the new bond must first be sold and the proceeds then used to retire the old bond, the company expects a 2 months of overlapping interest. Beautiful question. So what happening over here is for 2 months on the old bond, they will be having to pay interest and they have to pay interest on the new bond also. Beautiful question, friends. Shall we continue now? All right. 8%. What is the feasibility of bond refunding? Take a minute, write down the basic data. We'll go slow on this question. Enjoy the beauty of this question. Then we will do it together. Yes, friends. Are you all done writing till here in your books now? Shall I go to the next part? Okay. So, friends, now what we have to do is we have to categorize this into three parts. Part one, it will be the initial cash flow. Part two, in between cash flow. Part three, terminal cash flow. Shall we do it now? So, I'll mark it here itself. So, here they say that they are repaying back at what price? 1140. This will be an initial cash flow. Correct? Initial proceeds received. That was received when? Not now. It was received some 10 years back. Okay. So this is historical cost, not relevant for decision making. Discount of 30 rupees per bond was given. Is that discount amortized or unamortized? Let's read that. Initial floating cost was 3.6. Discount is 30. I'm not sure whether they have told anything about amortization over here. Nothing has been told, so there can be two interpretations over here. Either we can amortize the discount or we can unamortize. We'll keep it pending. Initial floating cost is again H. H means historical. Okay, past. Remaining life, okay. Par value 1000 is also okay. Flotation cost today, we have to pay this money. It is initial cash flow. Overlapping interest is also what it is, initial cash. After tax KD is already given over there, so we don't need to work it out separately. Everybody clear with this part now? Okay, just mark it. All right, friends, I believe you have done marking this also. Shall I go to the next part now? Okay. Friends, once you are done writing till here in your books, let me go to the next part. Initial outlay. So, friends, what I'm going to do is, hold on. Yes, let's just come down and read through it. This is the basic data. They have given the new bond initial outlay. Let's begin from here now. So friends, as I told you earlier, there is a call premium. They are calling back at 1140, whereas the face value is how much? 1000. So the extra money what is coming over here into 30,000 is turning out to be how much over here? 42 lakhs. Tax savings on premium on redemption. So on this 42 lakh, you will get a 40% tax advantage. So after tax call premium becomes how much? 25 lakh 20. Now you are paying a flotation cost of how much? 4 lakhs. On this flotation cost also, there is going to be a tax advantage. So let's just check that part. Tax savings from unamortized flotation cost. So friends, that's what I was saying. What have they doing is they are apportioning this flotation cost over the life of the bond. So let me just explain this to you in writing. How much is the old flotation cost, friends? 1 minute. Initial flotation cost is how much? 3 lakh 60, correct? Yes. This 3 lakh 60 and the new flotation cost is how much? It's coming to 4 lakh. Let us do this one by one, friends. So I'll just write down over here. You can give a separate point over here. It is assumed that flotation cost of, how much is the flotation cost of initial one? 3 lakh 60,000 has been amortized over the life of the bond. Hence, balance to be amortized will be how much, friends? Total 3 lakh 60,000. Total life is how much? 30 years. Into how many years are we doing it? Are we doing it for 25 years? So everyone tell me what is. Do you get the answer as 3 lakhs over here, friends? This is amortized. So the moment you amortize this, on this 40% will be your immediate tax advantage. That turns out to be how much? 1 lakh 20,000. That is the amount that you see over here. Can you write down this in your books now? Yes, friends. Are you all done writing till here in your books now? Okay. So same way, now we need to also do the assumptions. I'll write down the next working note. Analysis of new flotation cost. So now tell me what will happen in case of new flotation cost, friends. How much is the new flotation cost? 4 lakh. This will be apportioned over how many years now? 30 years, correct? So what is 4 lakh divided by 30 years? Is it turning out to be 13,333 rupees every year? On this, every year you get a 40% tax advantage. Does that turn out to be 5,333 rupees every? Sorry, it's for 25 years, right? So sorry, it will be different. 25 years. Do I get the answer as 16,000 into 40% will be 6,400 will be the per year operating savings. Can you write down this also in your books now? All right, friends. I believe you're all clear with this part. Now you look at this. Flotation cost 4 lakh will come now. This advantage will come from year 1 to year 25. Old bond immediately written off. That flotation cost pending is immediately taken into the account. Now, tax savings on unamortized discount on the old bond. Now, let us see what is the discount of the old bond. Okay, so you have 30 rupees per bond as a discount, correct? We'll write down the next working note. Discount on old bond. Okay. Now tell me, what is the total face value? 3 crore or 300 lakhs. What is the face value per bond? If I'm not wrong, it is 1000, correct? Just confirm. Yes, it's 1000. From this, can I get the number of bonds? Do I get the answer as 30,000 bonds? How much is the discount they have told per bond? 30 rupees. So what is the total discount that they have given? Is it turning out to be 9 lakh? 9 lakh is a discount for how many years, friends? It is a discount for 30 years, correct? So 9 lakh divided by 30 into 25. 9 divided by 30 into 25 will be 7 lakh 50,000 will be written off in this year. Everybody clear with this part? Of that, 40% is going to be my tax advantage. Do you get the answer as 3 lakhs over here now? Correct? That is the same number that they have written over here. Okay. So can you write down? So in bracket again I will give, it is assumed that discount is amortized. Beautiful question, friends. I hope you are all comfortable with this. FF, what is your full name? You are rank 1 now. For the year, is it? Are you all done writing till here in your books now? Okay. So friends, once you are done writing till here, same way, is there any discount on the new bond? Please confirm. Then that also will be amortized in that case. Let's go and check. No. New bond, initial proceeds 2.91 crores for old bond or new bond? 1 minute. Initially collected 2.9. That's initial. The new bond at par value. There is no discount for the new bond. So that's it. So I think we have covered the major points, friends. Let's come down now. So as I told you earlier, we had 42 lakh. That is a call premium. Tax saving. We talked about this. 1 lakh 20. We spoke about this. 3 lakh also we spoke. Now there is an overlapping interest on the old bond. That part is pending. So you can write down the next working note heading. Overlapping interest on the old bond. Everybody clear with this part? So here what happens is you have an old bond with a face value of how much? 300 lakhs. On this earlier, I think they were charging 14% interest for how many months now? 2 months. On this, we will have to do a 1 minus 40%. 14 is correct, right? Yes, 14 is correct. Okay. So now it will be 300. Do you get the answer as 4.20 lakhs? So that is going to be your overlapping interest. 7 lakh minus 2 lakh 80, 4 lakh 20. Write down. All right. Now you can write down the initial cash flow or the initial outlay. Please do it, friends. Yes, friends, are you all done writing till here in your books? So we are done with your initial cash flow. After we are done with the initial cash flow, what is the next thing that comes over here? In between cash flow. So now in our in between cash flow, One, you have the interest to be paid on the new bond minus interest to be paid on the old bond. You have a savings. On that savings, you will have a tax impact. So after tax, whatever comes in there will come in as point number one. Point number two that will come over here will be, I think here we found out the answer as 6,400 per year. The new flotation cost advantage that you will get is 6,400. Old is over. Old flotation cost is over. The new one will be 6,400. Let's check. 6,400. 1 minute. What have they done over here? Discount is also considered, is it? Wait. Total they have got the amount as 10,400. I'll just work this out separately. This, I think the way they have done it here will be very confusing. 10 lakh 50, they have put a star. Where is the star here? Okay, that is 9 lakh. That is a discount amount if I'm not wrong. Plus 3 lakh 60. On this total 25 by 30 when they did, they are getting the answer as 10 lakh 50. Wait, let me do it in my style. Okay. So we'll just write down whatever they have put up over here. 9 lakh is the discount price, correct? Please confirm. Yes. Discount amount is how much? 9 lakhs. Plus, what was the unamortized portion of this one? 3 lakh 60, is it? 3 lakh 60 is what? The flotation. So this is the total for how many years? 30 years. So how much is 9 lakh plus 3 lakh 60,000? Is it turning out to be 12 lakh 60,000? Correct. So therefore, unamortized portion is how much? 12 lakh 60 divided by 30 into 25. Does that turn out to be 10 lakh 50? I think that's the same number that they have got here. Correct. Minus 4 lakh is what they have done. Then whatever, okay, this is the unamortized portion. So can I say if we had not converted to the new bond, my amortization on the old bond would be how much per year? That would be 10 lakh 50 divided by 25. I would have got 42,000 rupees every year. On this, every year, I would have got a tax advantage of 40%. I would have got 16,800 as my tax advantage. Now, since I'm not getting it, this will become my opportunity cost. Do one thing, write down till here. I will give you in a sentence format as to what they mean over here. All right. So just write down the next working note heading, opportunity cost. Yes, friends, are you all done writing till here? Now I'll give you a write up so that you can understand what's happening over here. Okay. If we had continued if we had continued with the old bond, I could have amortized, I could have amortized 10 lakh 50,000 over 25 years. I would have got tax benefit of, I would have got tax benefit of how much, friends? 16,800, which I lost now. Hence, 16,800 is my opportunity cost. 16,800 is my opportunity cost. Everybody clear with this part now? If I go to the next one, that is over here, we have got a new flotation cost is 4 lakh. When I amortize, this is my opportunity gain because I am making 6,400 every year. Correct. So now what is happening here? The advantage will be 16,800 minus 6,400. Minus 6,400. So when I do this, do I get 10,400 as my net opportunity cost? That is the number they would have written over here. See, beautiful. 16,800 minus 6,400 will be 10,400, which is my net opportunity cost. All right, friends, are you clear? Now you come back over here and you write down the in-between cash flow. So you get 3,49,600. Yes, friends, are you all done writing till here? Now you have year 0, you have year 1 to 25, and you want to work out the NPV. NPV is positive, hence we should accept the project. Can you write down and finish it off, friends? Yeah, Deepthi, I believe I've told about 6,400. 6,400 is your flotation cost. So the new flotation cost is 4 lakh. Divided by, when you do it for 25 years, you get 16,000 per year. So that into 40% tax means every year I'll get 6,400 as my advantage because I shifted to the new bond. Okay. Write down and finish it off. We are done with this question. Please write down. All right, friends. So I believe we are all done writing till here in your books now. So we are done with this question also. I think that's it, friends. So I hope you all can see me. Yeah. That's it, friends. So we are done with this first chapter of bond valuation. I hope you are all clear with this entire concept. We have covered everything, friends. Nothing has been left out, but we did the entire thing in a very short span of hardly 4 hours actually. Yeah. Is everybody clear with this part, friends? Type a yes in the chat box. Shall we go to the next chapter now? Excellent. Let us go to the next chapter, share valuation. So we learn the concept now, then we'll take a break. After the break, we'll start cracking problems on share valuation. Okay. Share valuation. Friends, just like we did bond valuation, now we will do share valuation. So the rule again remains the same. Value of a share is nothing but it is the present value of future cash flows. Okay. Now, in this, we have multiple models to learn. So, in this, the first and the most important thing that we need to learn is there are some terminologies such as dividend rate, dividend yield, dividend payout. Dividend rate, the formula is DPS divided by face value. Dividend yield, the formula is DPS divided by MPS. Dividend payout, the formula is DPS divided by EPS. Same way, if you want to find out the retention ratio, the formula is going to be 1 minus payout ratio. 1 minus payout ratio. Everybody clear with this part? Yes. Now, once you're done with this one particular concept, there's one more concept to learn, that KE is what? It is equity holders expectation. Now, KE can be found out using multiple formulas, friends. One, we can use the formula 1 divided by PE ratio. There is another formula, that is CAPM, or here it is RF plus beta equity into RM minus RF. Or you can find this out using Gordon's model, which I'll teach you very soon. You can also find this out using Walter's model. But out of all these, this model is the best model. Can you quickly write down these formulas in your books? All right, friends, shall we begin now? Okay. So, friends, now in this, once you've learned with KE, I will now quickly go to the next concept, that is the Gordon's model. So, under Gordon's model, P0 is equal to D1 divided by KE minus G. So, this is also nothing but the perpetuity formula, friends, cash flow divided by discount factor minus growth. So, D1 can be found out using the formula D0 into 1 plus G. KE is normally found out using CAPM. G is found out using a formula called as BR, where B is nothing but the retention ratio and R is nothing but the ROE, or rate of return. That is PAT divided by equity plus reserves. Quickly write down, friends. Yes, Deepti, what you said is absolutely correct. All right, everybody clear with this part now? Okay. Once you're done with this, we'll go to the next model that you need to learn, which is called as the Walters model. Here the formula is P0 is equal to D divided by KE plus E minus D into R by KE whole divided by KE. All right. So when you work it out in this way, you get D is dividend, E minus D is the retention money. And this is the present value of dividend. And this will be the present value of retained earnings. Friends, the detailed concept video is available in my website. You can always take it from there. After we learn about this, the next major concept that comes over here is that MPS after dividend is found out using the formula MPS before dividend minus whatever is the dividend amount. Same way, if you want to find out the MPS after bonus, that will be found out using the formula market value after bonus divided by number of shares after bonus. MPS after buyback is found out using the formula market value after buyback divided by number of shares after buyback. MPS after rights issue is found using the formula. What is the formula, friends? Market value after rights divided by number of shares after rights. Can you quickly write down this in your book, friends? We have reduced, Deepti. We have reduced it. If you want to show you, I'll show you. Look at this. 16,800 minus 6,400 is 10,400. Quickly write down all these formulas in your books now. Are you all done with this part, friends? Deepti, the question we added, well, let me check it, Deepti. 10,400. 10,400, it's the same, Deepti. We didn't add. Its minus is given here. We didn't add. It's done correctly. All right, friends. Are you all done writing till here in your books now? Okay. After you learn about MPS after rights, they may also ask you a question called as value of a right. Value of a right is MPS after right minus MPS before right. And sometimes they will ask you a question called as value of rights alone. Then the equation is MPS after rights minus the rights price. Okay. Can you please write down this in your books now? All right. I believe you're all done with this. Then friends, sometimes they may also ask you a question called as stock split and reverse stock split. So stock split means if you have one share of 10 rupees, you can break it down into two shares of 5 rupees. That's called as a stock split. Reverse split is if you have two shares of, let us say, 50 rupees, you can merge it back into one share of 25 rupees. This is a 2 is to 1 split. This is a 1 is to 2 reverse split. That's it. So we have covered all the conceptual areas, friends, of share valuation. Shall we now do the problems of this part? Are you all done writing? Take a minute, write it down. All right. So I believe you're done with this. Let us start cracking problems on this one now. So let's take the next chapter book now. We call this chapter as either dividend policy or share valuation. Okay. Let me come down. I think I've done it concept wise here. 1 minute. Okay, it's done concept wise. So let's crack it concept wise. 1 minute. Wait, have I made a mistake in what I've written over here? Sarvamangala. Let me cross check. 1 minute. Value of a right is correct. Correct. It's before rights minus after rights. Before will be higher than after. Correct. Please correct it there, friends. Market price before rights minus market price after rights. Srividya, thank you. Thank you so much. Reverse split would be two shares are merging into one share of, again a mistake over here. Sorry friends, it will be one share of how much? 100 rupees each. Okay, thank you so much. Thanks a lot for correcting me here. I think friends, we'll take a short break now. My brain is saturated after working out so many questions. I'm also not keeping fully well, but I didn't want to cancel today's class. Can we take a short break? Yeah. Let's take a minute. Avinash, can I speed up? Others also, please let me know if I can speed up a little bit more or is the pace comfortable? We'll go by the majority. So just write increase pace, decrease pace, or no, this pace is enough. Comfortable, increase, comfortable. So I think I can do a little increase in the pace, right? Mary, this is enough. That's what I'm a bit confused. If I speed up, the drawback would be if suppose 100 people are watching it, out of this 100, if suddenly I speed up a little bit, suddenly everybody might, get a bit stuck. Let's say 40, 50 students might get stuck. So better than that is we go at a comfortable pace and we cover everything, whatever we're doing with full quality. And I believe we are doing quite a lot of questions. So nothing to worry. Let's go at this comfortable pace. Okay, let's not speed up any further. Okay, perfect. So friends, let's take a short break. We'll take a 15 minutes of break. After that, 11:30, we'll start with the next session up to 1 o'clock. Then we'll have a lunch break up to 2. 2 to 4 will be my final session. Like that, we'll be doing 3 days, friends. All right. Perfect. So I'll see you after 15 minutes of break. Thank you so much. Friends, I'm live. Are you able to see me? Yes, I hope my audio and video is both clear to all of you. Please confirm that also. Perfect, perfect. So now shall we start cracking questions on share valuation, friends? Let's do it one by one quickly. So I think we learned about dividend rate, dividend yield, dividend payout. Question number one, a very easy question. Take 1 minute, solve it yourself. Come on. So friends, question number one, take 1 minute, solve it on your own. Yes, friends. Shall we now check it together? Okay. DPS is given, EPS is given, market price is given, face value is also given. So if you work out the dividend payout, that is DPS by EPS, you get 41%. Yield, you get 13.16%. Rate, you get 25%. Retention ratio will be 1 minus payout ratio, 58.33%. A very, very easy question, friends. This question may not directly come in the exam, but they will use these equations as a part of some bigger question, friends. That time it will be useful for all of you. Okay, perfect. So I believe all of you are done with this part now. Can I go to the next question? Yes, that's the same thing. Let's not waste our time on that now. I think we are done with question number one. Look at two, friends. Same thing. DPS, EPS, market price, face value. So all that you have to do is you have to just work out this question and you will get the same answer. Everybody clear with this part now? So indirectly we have done question number one also. We have done question number two also. Now let me take the next one. This is okay, not relevant. KE and PE ratio we have learned. Okay, this question once came in the exam. It is based on another approach called as the common sense approach. But I'm not sure. I don't think they're asking any more questions on this at the final level. This is more at the intermediate levels. I'm keeping it pending. Let's focus on what comes in final. The Gordon's model comes at the final level. All right, you have retention ratio. Fine, I think we'll do a very easy question to start off with. Okay, question number 6. Let us do question number 6. Come on. It's not very tricky. You know about Gordon's model. So try doing it yourself. Take a minute and do it yourself. All right, friends. Now what's happening is they have given you the rate of return. R is given, KE is given, dividend price today is given, and the EPS is also given. So basically from this what happens is you can find out the retention ratio. Retention ratio into rate of return will give you what? Growth. Once you get growth, you can find out D1. And then you can find the price using Gordon's model. So you get the retention ratio over here as 37.5 percentage, correct? Then you take the growth, G is equal to BR. So you get 3.75 percentage. Then when you go down further, you get the dividend next year is how much? 25.94. And the price today will be using Gordon's model 182.04. Is everybody clear with this question, friends? All right. So we are done with this question also. Now let's come down. Let's do a better question. This came in the exam. So I think better we do it now. Yeah. All right. Question number 7. Shall we do it? Okay. Working note number 1. Basic data. Question number 7. Share valuation. Working note number 1. Basic data. In December 2011, AB company's share was sold for 146 rupees. All right, a long-term growth rate is 7.5 percentage. And their company is expected to pay a dividend of how much rupees per share? 3.36 rupees per share. Expected means D1. Alright. Now, from this, they are asking you what rate of return an investor can expect to earn, assuming that dividends are expected to grow at the rate of 7.5 percentage towards perpetuity. So, friends, what is happening over here is they want you to find out the KE. We know the formula P0 is equal to D1 divided by KE minus T. Therefore, P0 is equal to 3.36 divided by, sorry, P0 is how much? Is it 146? %7.5. Now, when you do this, 2.3 percentage plus 7.5. Do I get the answer as 9.8 percentage? Okay, that is the answer for the first part. Can you all write down this in your books now? Perfect. So we are done with part one. Shall I go to the next part now? All right. Now they're asking, it is expected that AB company will earn about 10% on book equity and shall retain 60% of the earnings. In this case, whether there would be any change in the growth rate and equity. So I'll write down the next working note heading. Analysis of situation number two. Analysis of situation number two. So there, what we'll do is they have told that it's earning around 10% on book equity. So point number A is what? ROE, 10 percentage. All right. Then shall retain 60% of their earnings. So what is the retention ratio? Okay, from this, can I find out my revised growth now? What is my revised growth? You will get the answer as 6%. All right. Once you get this answer as 6%, then they are telling that would there be any change in the growth? Yes. And now they're asking you how much is going to be your K. So friends, what I can do in this case is I can write down the same equation now. 146 is equal to 3.36 divided by some KE minus 6%. Therefore, my KE will turn out to be how much now? Do I get the answer as 8.3%? Friends, this is one method of solving. Your ICAI study material has solved it in one more method. First, you write down till here, then I will explain the second method. Yes, perfect. Very happy to see you all actively interacting over here, friends. Are you all done? Okay. Let's check if that's how the textbook has done it. Yes, here also they have got the answer as 8.3 itself. Friends, I'll just give you an alternative solution. I don't exactly recall, but let me just try doing it. Can I go to the next part now? I'll write down the next working note heading, alternative solution. Okay, I'll just try doing it. Okay, wait. So here what happens in this case is that they have told that retention ratio is turning out to be 60%. Correct? Wait. Originally, what was the D1 that was given over there? Was it given as 3.36? Earlier, what was the retention ratio earlier? I think earlier the retention ratio was, earlier the growth was 7.5 percentage, correct? So can I say some retention ratio into 10% ROI was giving you 7.5 percentage? Therefore, earlier the retention ratio was nothing but 75 percentage if I do a reverse working. Therefore, the earlier payout ratio was actually how much? Was it 25 percentage? Therefore, EPS turns out to be 3.36 divided by 25 percentage. You get the answer as 13.44. Then what they are saying is that now the new growth is how much percentage, friends? 6 percentage. What is the new RR or retention ratio? I think that is 60 percentage. So what will be your new payout ratio? Will it turn out to be 40 percentage? Correct? If the new payout ratio is 40 percentage, can I say 13.44 into 40 percentage will be your new D1? Is that turning out to be 5.376? So therefore, 5.376 divided by sum KE minus 6% growth should give you the answer as 146. So you get the answer as how much under this method? 9.68 method. Okay. So this way, when you do it, friends, you get a different answer. Why the answer is different is because there are some difference in the assumption. In this working node, we have assumed that D1 will remain the same. But when I solved it using this method, here I have assumed that E1 will remain the same. That is how the answers are changing. Everybody clear with this part? Quickly write down this also. We are done with this question. But write down, I think there's the last one small adjustment is there, which also I will explain to you. All right, friends. Now let's read the last requirement. In your opinion, what payout will ensure that the share price is maximum? Friends, I'll just give you the theory for that also. There is a theory that if R is greater than K, you should go for 100%. Sorry, R greater than K. So here the return is more. You should go for a 0% payout. If R is less than K, you should go for 100% payout. The logic is when I get a better return compared to what my father gives me, it is better that my money stays in the company itself, hence 0% payout. But if the company is giving me less than what my father gives me, you should give me 100% payout. If R is equal to K, it is an indifference point. So in this example, R is 10 percentage, K turns out to be 9.8 percentage. Therefore, R is greater than K. So if R is greater than K, what is your optimum payout ratio in this question, friends? It will be a 0% payout. Everybody clear with this part now? Quickly write down this. We are done with this question. All right, friends. So we are done with this. Shall I go to the next question now? Okay. 0% payout. Alternate solution is also given over here, friends, where you got 9.68, even that is given over here. Okay, both are covered. Great. Now, shall I go to the next one is on Walter's model. Okay, let's do question number 9, which is a question on Walter's model. Page number 4.B.30. Friends, in the ebook, I have given you chapter wise, okay, so it becomes easy for you to study through it. Now, it's an easy question. What's the formula for Walter's model? Everyone tell me. D divided by K plus E minus D into R by K whole divided by K. Try doing this on your own using that formula. Take 2 minutes time. Jeevan Sneha, in that question to find out EPS, they are using D1. But in reality, it should be based on D0. What you said is correct. Such assumption mistakes are always there in this chapter. Okay. Yeah. Now try doing it yourself. Yes, friends. Shall we discuss it together? They have given you the profit, preference share, debenture, equity share, payout ratio is given, ROE, rate of return is given, and the shareholders' expectation KE is given. So, from this profit, you should reduce the dividend, reduce the debenture interest, then you get the earnings available to whom? Available to equity shareholders. Correct? Once you get this, from that number of shares, when do you get EPS? From this payout ratio, you get DPS. Then you can use the formula 2.8 divided by KE plus this into R by KE whole by KE. The price will be 81.66. Take one more minute, try doing it yourself. If you don't get the answer, look at the board. Yes, friends, I believe you are all done with this. Hence, we are done with question number 9. Shall I go to the next question now, friends? Next question is a beautiful question. Shall we do it? Question number 10, share valuation, working note number 1, basic data. Basic data. X has an IRR of 20%. So here, friends, what they meant by IRR is the return of X. That is the actual return of X. Actual return of X is equal to how much percentage? Declared a dividend of 18%. So dividend rate 18%. Face value is how much? 10 rupees. 10 rupees. Payout is how much percentage? 36 percentage. 36 percentage. P ratio is 7.25 times. 2.5 times. Find the cost of equity using what model? Walters model. So friends, from this data, whatever you have over here, I will write down working note number 2, analysis. So here we can go and find out the hidden information. All right. So the dividend rate is 18%. So from this, can I say my dividend amount will turn out to be 10 rupee into 18%? That is 1.80 rupees. Point number B, if that is the case, can I also go and find out the EPS, that is 1.8 rupee divided by 36 percentage. Here DPS is D1, yes. Walters model, we don't differentiate between D1 and D0 menu. It will be the same. Do I get the answer as 5? Once I get this, I can also find out the MPS. How do I find out the MPS? 5 into 7.25. I get the answer as 36.25. Now, all this data, write down and understand the question till here. Yes, friends. Shall we now do the remaining part? All right. So once you got this answer, I'll go to working note number 3. KE using what model, friends? KE using Walter's model. So friends, here we'll form an equation. P0, price today, is equal to D divided by K. We don't know what is the K, so I'll assume K to be X. Plus E minus D, that is 5 minus 1.8 is 3.2 into zero point 0.2 is 0.64 divided by K square, because we have to do divide by K whole divided by K. Now to solve this, friends, we'll have to, I'll call this as equation 1. I will have to first eliminate the denominator, so I will do equation 2 is equal to equation 1 into x square. So I'll get the number as 36.25 x square is equal to 1.80 x plus 0.64. 36.25 x square minus 1.80 x minus 0.64 is equal to 0. Beautiful question. How do you solve it from here, friends? Take 1 minute, think and tell me. Anyone tell me, how do you solve it? Do you remember a concept called as the quadratic equation? Nobody is responding. Friends, this can be solved only using some mathematics that you have learned in your 8th standard or 9th standard, which is called as the quadratic equation. As per the quadratic equation, the equation will be minus b plus or minus square root of b square minus 4ac whole divided by 2a, where the first part is what will be your a, this will be your b, this will be your c. Fantastic. So now the equation will be minus 1.8 will be plus 1.8 plus or minus square root of b square 3.24 minus 4 into 36.25 into minus 0.64 whole divided by 72.5. So it will be equal to 1.80 plus 9.8 whole divided by 72.5. Do you get the answer as 16 percentage? This is the KE using what model? Using the Walters model. Come on, friends, write down and finish it off. Beautifulest question. Beyond this, no question will come for Walter's model. All right, friends. So I believe you are all done writing till here in your books now. So we are done with question number 10 also. Friends, down they have given you another part that determine the limiting factor of its share in case the payout ratio is varied. I'll just explain that also to you quickly. But as I told you, I am not sure they are asking this anymore at the final level. So just cross check that part, all right? So I'll just quickly do it for you. We have learned that if R is greater than K, we should go for a 0% payout. If R is less than K, go for a 100% payout, right? In this case, R is 20%, K is how much percent? 16%. Am I right? Therefore, can I say R is greater than K? So, what is the optimum payout ratio? In that case, it will be 0%. So, what they are trying to tell is that if payout is 0%, since it is optimum, price will be maximum. And if payout is 100%, what will happen to the price, friends? Price will be minimum. This minimum price is what we call it as the limiting factor. Quickly write down this also, friends. So we are done with this area also. All right, friends. So we are done with a very, very good question. This is not applicable to you. Lintner's model, etc. I have covered here because it is there at your inter level, and at the CA final level, they have the right to ask you some of the areas of the inter level also. So these questions had come 4-5 years back, they came in the exam. So I don't want to leave out on the concept in my mastery book, but in the 25-hour marathon, we don't need to cover all this. All this I'll take in the inter FM marathon that I'm planning very, very soon after this. Wait. All right. Now let's do a quick question on bonus shares. Are you all ready? Friends, we have learned the concept of MPS after bonus. Everyone tell me, how do you find out the MPS after bonus? That is market value after bonus divided by number of shares after bonus. Take 1 minute, do this on your own, then we will discuss it together. Yes, friends, shall we do it together? How many shares are there? 1 lakh. Market price 100. Total market value 100 lakhs. They are going in the ratio of 1 is to 1. So for every one share, they are offering another one share. So like that, you'll get 2 lakh shares. So now the MPS will become how much? 50 rupees per share. Easy? Yes. So we are done with a question on MPS after bonus also. Now we'll do rights issue. Let's start with an easy problem, friends. Okay. All right. Same way, take 1 minute time. Try doing buyback of share. MPS after buyback. What is the formula I told you for MPS after buyback, friends? Market value after buyback divided by number of shares after buyback. Try doing this yourself first, then we will go to the next question. Yes, friends, a very easy question. Shall we discuss it together now? So 1 lakh shares, earlier the market price is how much? 25. So the market value after buyback is how much? 25 lakh. But now what's the number of shares after buyback? It's only 90,000. So earlier the price was 25. Now the price has come up to how much? 27.77. Everybody clear? This is theoretical price, okay? Practically, buyback is a negative sign. So the moment there's a buyback, people will not treat it properly. They'll start selling. And when they sell, the prices will eventually fall down. So we are done with question number 16 also. This is a very good question. I think we have a similar type, one more question somewhere. We'll do that. So that other question has come very frequently in the exam. So let's do this, friends. Question number 18, it's a question on stock split and reverse stock split. So you have a 2 is to 1 stock split, then you have a 1 is to 5 reverse stock split also. So 10,000 shares of 100 rupees are there. How do you do this into a 2 is to 1 stock split? For every one share, you'll be given how many shares? Two shares. So instead of having 10,000 of 100 each, what will happen now? You will have 20,000 shares of only 1 minute. 20,000 shares of 50 rupees each. Correct. 20,000 shares of 50 rupees each. When you are going for a 1 is to 5 reverse stock split, instead of 10,000, you will have only 2,000 shares. But the price will become 500 rupees per share. So that is how you treat a 1 is to 2 is to 1 stock split and a 1 is to 5 reverse stock split. Everybody clear with this part? Shall I go to the next one now, friends? Let us do a question on two-stage dividend discount model. One moment, friends. Yes. Now we'll do a question on two-stage dividend discount model. It's a very, very good area which comes in the exam very, very frequently. Shall we do question number 19 now? Question number 19, two-stage dividend discount model. I'll draw a chart and explain this to you. Ramesh is foreseeing a dividend growth rate of how much percentage? 12 percentage per annum. So, in the first 2 years and third and fourth year, it will fall down to 10, then it will stabilize at 8 percentage. So, let me put it like this: D1, D2, D3, D4, and then you have D5. So then we start with the last paid dividend. D0 is how much? 1.50. Now they are saying it's growing at 12%. After that, 10%. After that, how much percentage, friends? 8 percentage. So the K is how much percentage over here? 16 percentage. No, Sanju. No. That interpretation is not correct because market value before and after buyback will remain the same. Here I'll get 1.68, 1.88, 2.07, 2.28, then you have 2.45. Everybody clear so far? Right. So once you are done with this part, they have told that from here you are going to go at 8 percentage forever. So what happens is you have two parts. This is what we call it as high growth cash flow. And this is what we call it as perpetual cash flow. Okay. Draw the diagram till here and understand till here, friends. I'll then go to the next part. Right, friends. Now, shall we continue with the next part? So now when I find out the present value, I go by two steps. Step number one will be present value of high growth cash flow. Step number two will be present value of perpetual cash flow. So here I'll draw a table here. Cash flow, discount factor, discounted cash flow. So what are the numbers I got? 1.68, 1.88, 2.07. Then you have 2.28. And last year will not come there. What is the discounting factor they have told over here? 16%, correct? Last year is D5. D5 divided by KE minus G will give you price at the end of the fourth year. So, how much is the D5 that we got? 2.45 divided by 16% minus 8% growth rate will give you 30.625. This will come in the fourth year. Then you should take a discounting factor at 16% and find the present value. Can you please find out the present value and tell me the answer in the chat box now, friends? I will wait for you to give me the answer. Do you get the answer as 22.33, friends? Have all of you got that answer? Shall we cross check? Yes, 22.40 approximately. Perfect, friends. So that is the right answer. And with this, we are done with the concept of two-stage dividend discount model. Can I go to the next part? Friends, this is a good question, but conceptually nothing new over here. Can you do this on your own? Please mark it as homework. If I do all this, then we may not get time for other chapters. Okay. But it's a very, very good question. You have to work it out once. All right. Yes. Then we have practice questions over here. Friends, in the practice questions of share valuation, you have a lot of questions where there are a lot of illogical parts. So that's something what you have to be careful about when you're putting the base. I'm going to do some different types of questions. The routine type, I'm not wasting time here. Okay. Let us do question number 5, which is a study material question, page number 4.b.74. It's a practice question, friends. Earlier, what we did were the conceptual questions. It's a very easy one, but I want you to try doing it on your own. Can you please take 2 minutes of time, scribble down the numbers and try solving it yourself? Yes, friends. Now tell me, how do we solve this? Growth rate is given as 10%. Company has paid D1 or D0? D0. That is 3. RM is given, RF is given, beta is given. Why have they given these three things? To find out KE. So once you get this, once you put the data, you can go and find out your KE. And once you get your KE over here as 14 percentage, you have all the other data like D0 is given, growth is given. You can find out the price using Gordon's model, D1 divided by KE minus G. Or if they have put it in a different way, but it's the same thing. You can use Gordon's model formula. You get the price as 82.5. Have you all got this answer in your books, friends? Fantastic. So we are done with this question number 5 also. Hold on. Anjana, you have a confusion, right? Yeah, always last paid dividend is D0, Anjana. The expected dividend is D1. Perfect. Can we try? This was also an examination question. It will get over quickly. Can we do it in 2 minutes time? Question number 6. Take 2 minutes time. Try doing it yourself. Yes, friends. Now tell me, shall we do this together? So what's happening here is the price is 46. The last year it declared dividend of 5 rupees. So it's the last year dividend. So what will it be? It will be D0. Am I right? The company has made a return of how much percentage over here? 15 percentage. So that is the ROE. And I think they have a growth is given as how much? 10 percentage. And I believe 15 is their expectation. No, that's the ROE. I took it correctly. So ROE is given correctly. G is also given. That is 10% for the first 3 years and thereafter 5%. So friends, we have to do using what model? Two-stage dividend discount model. So 5 will become 5.5, 6.05, 6.655. KE is given. So when you take the present value based on this, you get 13.74. Now you have to do the perpetual growth rate. Once you do the perpetual growth rate, you get the net P0. You can do it in the table format also, friends, how I have taught you. You don't need to do it this way. Okay. You will get the same answer. So this is another good question on two-stage dividend discount model. Are you still doing, friends? Let them do it. Let them finish it. All right. All right, friends. I believe you're all done with this part. Okay, now that's a very good point what you have told. Correct. What they have done is they have actually given ROE, but they have solved the same thing using KE. So sometimes what happens, you can give a note in your book, friends. The note will be in the absence of information, ROE and KE will be the same. Okay. So I think we are done with this question also, friends. Next is the same. No, next is not the same. Next is actually a very good question. I think we can do this question and we can then go to rights issue. This is a very, very good question. Let's do this. So after those two questions, I'll give you a break. Then after lunch, we'll start with portfolio management. Okay. Question number 7, page number 4.B.76, working note number 1, basic data. Working note number 1, basic data. Fine. Sam has just paid a dividend of 2. Is that D1 or D0? D0. And it is expected to grow at the rate of 6% per annum. After paying dividend, the board declared to take up a project by retaining the next 3 annual dividends. So in the next 3 years, will you get any dividend? No, you won't get any dividend. The result of this project will start coming from the 4th year onwards. So 4th year onwards, the dividend will become 2.5. So dividend from 4th year onwards will be equal to 2.5 rupees per share. And what is the growth rate that they have told over here? And will grow at 7%. Revised growth is equal to 7% per annum. Everybody clear so far, friends? Okay. Now, after giving this, an investor has 1,000 shares of SAM. Thousand shares, and he wants at least 2,000 per annum. Okay, at least 2,000 per annum from investment. Can you write down till here in your books, friends? All right, friends. Now interact with me. So basically, what will happen now? Year one, year two, year three, there is no dividend. But this fellow wants how much rupees per annum? 2,000. How will he generate this money now? He will generate this money by selling shares. Okay, so we'll write down over here. In order to earn 2,000 per annum for 3 years, what is the fellow's name? Sam will have to sell shares. Everybody clear with this part now? Okay. So now what will happen is we need to find out the price per share in each of these years now. Correct? Now, first I'll write down. So we'll write down working note number 2. Analysis of price per share. So I'll write down P0 is equal to D1 divided by KE minus G. Am I right? Yes. So now tell me, how do I find out D1? D0 is 2, correct? So D0, 2 and 6% growth rate. So can I say 2 into 1.06 divided by what is the KE? Have they given the KE over here? No, is it? Let's check. Cost of capital is 8%. 8% minus 6%. Do I get the price per share as 106 rupees per share? Correct? Now, P1 will be equal to D2 divided by KE minus G. D2 will be nothing but 2 into 1.06 whole square divided by 8% minus 6%. Do I get the answer as 112.36 rupees per share? Let me just confirm this number, friends, because they have given two growth rates. 106 is the price of the bond now. 1 minute. Okay. Expected price after 3 years is what they have considered and they have brought it down. So in that case, this number will not be correct. We'll have to change the numbers, friends, because the future cash flows are changing. Correct? So I'll just give a note below this. Hold on. I'll give a note below this. This is the price after assuming that D0 is 2 rupees and G is how much percentage? 6 percentage. Now what I'm going to do is I'm going to the next page and write down working note number 3, price at the end of 3 years. Why? Because that is when you're going to declare a new dividend. Correct. So P3 is equal to D4 divided by KE minus G. Correct. How much is D4 now? I think they have told they are retaining the dividend for 3 years, and fourth year they'll be giving a dividend of how much? 2.5. Correct. Divided by 8% minus 7%. Do I get the answer as 250 rupees? If that is the case, P2 will be what? Present value of 250 rupees. That is 250 rupees divided by 1 point. What is the KE that we have over here? 8%, right? 1.08. Do you get the answer as 231.48? P1 will be equal to what now? 231.48 present value. Is that turning out to be 214.33? And P0 will be equal to 214.33 divided by 1.08. $198.45. Okay, can you write down this in your books now? Yes, friends, are you all done? So now what will happen is, how many shares this fellow is holding? Sam needs how much money every year? I'll put year 1, year 2, and then you have year number 3. Am I right? So year 1, if he needs 2000 rupees, what he will have to do is, he will have to divide it by the price at that period. What is the price at the end of year 1? 214.33. Here it is going to be 2000 rupees divided by 231.48. And here it will be 2000 rupees divided by 250. Correct? So here how many shares he will have to sell? He will have to sell around 9 shares, or I think 10 shares to be precise. Here he will have to sell how many shares? 9 shares. And here you will have to sell how many shares? 8 shares. Everybody clear? So all together how many shares are gone? 19, 27 shares are gone. Correct? How many shares are remaining with him in that case? Hold on. You had 1 minute. 1000 shares were there, right? So I'll write down a heading, shares remaining will be, you have 1000 shares available with you, minus all these, correct? So minus, you have 10 minus 9 minus 8. Now tell me what is the answer you will get over here. Do I get the answer as 973 shares? On these shares, I will get 2.5 rupees per share. So I will get how much money in my hand? 2432.5 rupees per is what I'll get in total. Am I right? So if I'm getting so much of money, is this more than 2000 or less than 2000? More than 2000. Since it's more than 2000, Sam will not have any concerns. I hope you're clear now, friends. Please write down this and finish it off. We are done with this question also. Now we'll do a rights issue problem and we'll wrap up our class on share valuation. Yes, we have a buyback question also. That also we will do. One buyback, one rights issue we will do. Okay. Thank you for reminding me, Sri Vidya. Thanks a lot. Can I go to the next page? Fine. So we are done with this question also. Let's go to the next one. We'll do a very quick question on rights issue. So friends, what is the formula for rights issue that I have taught you? Market value after rights divided by number of shares after rights. But before that, are you all done with this question? Perfect. So let's do the next question. Question number 8, page number 4.B.78, which is a question on rights issue. Working note number 1, basic data. Working note number 1, basic data. ABC Limited shares are currently selling at how much rupees per share? 13 rupees per share. So, there are 10 lakh shares outstanding. All right. The firm wants to raise how much money over here? 20 lakhs. Fund required is 20 lakh rupees. Can I find out what is my current market value? Is that turning out to be 10 lakh shares into 13? That is equal to 130 lakh rupees. Correct? So now, calculate the X rights price of the share and the value of a right if the firm is offering one share for every two shares held. So what is the rights ratio that they are looking over here? 1 is to 2. Okay. So everybody clear so far? So once you are done with the basic data, I'll just explain to you. Can I find out the number of right shares? I think that will be 10 lakh into 1 by 2, or do you get the answer as 5 lakh shares? Correct. Once you get this as 5 lakh shares, I can actually find out the rights price. The rights price will be they need a total fund of 20 lakhs. 5 lakh shares they are going to offer. So do you get the answer as 4 rupees per share? Everybody clear with this part? Perfect. So this is the initial data. Now from this, I need to go and find out what. I'll write down working note number 2. I need to find out what is the MPS after rights or what is the theoretical rights price. How do you do that? What's the formula? Market value after rights divided by number of shares after rights. Now tell me, how do you find out the market value after rights? Already the market value is 130 lakhs plus. What is the new shares that how much fund extra are you raising now? 20 lakhs divided by how many shares are there right now? 10 lakhs plus. What about the second one? Right share is how much? 5 lakhs. So now tell me, do you get the answer as 150 lakh divided by 15 lakh shares, or do you get the answer as 10 rupee per share? This is what we call it as MPS after rights. Once we get MPS after rights, then we can go and find out what is the value of a right. Everyone tell me what is the formula for finding out the value of a right? That is the MPS before rights minus what? MPS after rights. So MPS before rights is equal to how much? 13 minus 10. So do I get the answer as 3 rupees per share? This is going to be my value of a right. Last thing that we need to find out over here is what? Value of renouncing a right. So when I'm renouncing a right, how do I renounce a right? It will be value after right minus whatever is the rights price. What is the rights price over here? 4 rupees. So what is the answer I get over here? 6 rupees per share. Is everybody clear with the concept so far? Now you have to do the same thing when you have an exchange ratio of 1 is to 4. Friends, 1 is to 4. Can you do it as homework yourself? It is exactly the same thing. So first, can you finish writing till here in your book? I'll give you some time. Please write down. All right, friends. Are you all done writing till here? Now, in this question, we have one more part in the end. Analyze how the wealth changes from 1 to 2 and the 1 to 2. That part you can do it only after you do 2, friends. So, can you please do this 2 as homework and then just compare how there is a difference coming over here? 1 to 2 have a rights issue increases the shareholders' wealth. I'm not sure if that's what they meant. 1 minute. Okay, I think what they meant over here is that how the rights issue is changing their wealth is what they are asking. So I'll do one thing. I'll show you the three scenarios. Once you have a rights offer, there are three things. You can either accept the right or you can renounce the right. So I'll write down the first working note. Okay, wealth of a shareholder holding 100 shares if he renounce, sorry, we'll start with purchasing the rights. If he purchases the rights. So friends, when I talk about wealth, you can talk about wealth in two ways. One is wealth before rights, and the other one is what? The wealth after rights. Okay. So when you talk about wealth before rights, you are having 100 shares into, I think, 130 rupees per share, right? Or 13 rupees per share. 13 rupees per share. So what is 100 into 13? Can you tell me? 1300. After the rights, I think we talked about 1:2 ratio, right? So he'll be holding how many shares now? 150 shares this fellow is holding. And the MPS after right is how much? 10 rupees, correct? Does it turn out to be 1500? Minus, to buy that extra 50 shares, this fellow would have paid an amount for that. How much money did he pay for the right? Value of a right is 3. Right's price is 4 rupees, right? Correct. He's paying 4 rupees for this. So how much is that turning out to be? 200. So what is the net wealth that you get over here? 1300. Wealth before right 1300. Wealth after right is also how much? 1300, friends. Everybody clear with this part? Now I will show you the next working note. What if he renounces the right? Again, I will write down wealth. You have wealth before, then you have wealth after. Before is already established 1300. Afterwards, now you are holding only 100 shares, but the price has fallen down to 10 rupees. So, do you get 1000 rupees? But now, what will happen is this 50 shares you would have renounced it to somebody else, correct? And you're renouncing at what price? You're renouncing at 6 rupees. So, do you get the answer as 300 over here? Or do you get the total as 1300? Again, there will be no change, friends. Before and after will remain the same. But in the last scenario where he takes no action, I'll write down the next working note. No action. In this case, your wealth before and your wealth after will be compared. So your wealth before rights in this case will be 1300. After rights, now you're holding only 100 shares into 10, that is 1000. So here you make a loss. What is the loss that you make? 300. So what's the moral of the story? Purchase the right, renounce the right, no gain or loss. But if you take no action, you will lose some money. Can you write down this and finish it off, friends? All right, friends. So we are done with this question and we are done with a question on rights issue. Shall we do our final question on this chapter, friends, which is a question on buyback? Are you ready? I think we had a good question down somewhere. 1 minute. We've covered all this. This is a question I told you as homework. It's a similar type, another question. Same. 19 is also again the same. So same repeated. There are a lot of questions in your book, friends. This is a Gordon's model question. Friends, 21 also do it as homework. Question 21. It's a very, very good question. Do it as homework, okay? Okay, I need a question on buyback. 1 minute. All these are very, very easy questions. Let's not waste your time. Yeah, this question. But this is the same as what comes in the exam. There was one more variant. Yeah, we'll do this variant question. Same thing, numbers are different. That's all. Yes. Question number 28. Share valuation, page number 4.B.105. Working note number 1, basic data. Rohan Limited has surplus cash of how many lakhs with them? 150 lakhs. And wants to distribute 35% to its shareholders. So I'll write down cash to be distributed will be 52.50 lakhs. All right. I'll go to the next part. The finance manager of the company estimates that its share price after repurchase is likely to be 15% above buyback price. So your MPS after buyback will be 15% above the buyback price. Okay. Now, if the buyback route is taken, the number of shares outstanding at the present is how much? 10 lakhs and the EPS is how much? 3 rupees. So, number of shares 10 lakhs, EPS 3 rupees per share. Therefore, can I find out what will be your total earnings based on this, friends? Do you get the total earnings as 30 lakh rupees over here, friends? Perfect. So, friends, now from this, they are asking you to find out what should be the price at which the shares can be repurchased if the market value after buyback should be 320 lakhs. Point number H. Market value after buyback should be 320 lakhs. Let us take a minute, write down this, understand the question, then we will solve it together. Yes, friends. Are you all done writing till here? So now, friends, let us go and understand how to solve this. One thing what they have not given over here is the buyback price. So let us assume the buyback price is X. So friends, in that case, we have already learned the formula that MPS after buyback is equal to market value after buyback divided by number of shares after buyback. Or in other words, market value after buyback, we know what's the market value after buyback. Is it 320 lakhs? Divided by what is the number of shares after buyback? How do you find out the number of shares after buyback? Already they are having 10 lakh shares. Correct? 10 lakh minus using the surplus money, they will do a buyback. So what's the surplus cash available with them? 150 lakhs. No, 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 not 150. 52.5 lakhs. So this 52.5 lakh, they will buy back shares at the buyback price. So 52.5 lakh divided by X will give you the number of shares bought back. This should be equal to the market value after buyback, or this should be equal to the market price per share. So have they told the MPS after buyback will be how much, friends? 15% above the buyback price or 1.15x. So when I try to solve it, the equation will come like this. 320 lakhs is equal to 1.15x into 10 lakh minus 52.5 divided by x, or 320 lakhs is equal to 11.5 lakh x minus 60.375. The x will get nullified over here. 75 lakhs. So if I come bring it on the other side, it will become 380.375 lakhs is equal to 11.50 lakh x. So x will be equal to, please pray to God, friends, my answer is correct, 33.07 rupees per share. Shall we cross check the answer over here? Fantastic. We have got the right answer. Okay. Fine. Once you get the buyback price, then everything else can be found out very, very easily. I will give a heading called as conclusion. Buyback price is equal to how much, friends? 33.07. Okay. Therefore, what will be your MPS after buyback? That will be 33.07 into 15% above buyback, right? 1.15. That is 38.03. If that is the case, we can find out what are the shares bought back. So how much is the surplus money with them? 52.5 lakh, 52 lakh 50,000 divided by 33.07. 1,58,754 shares. Then I can find out A, B, C, D. Shares after buyback. The shares after buyback would be, I think initially how many shares were there? 15 lakh, is it? 10 lakh shares. So it will be 8 lakh 41 to 46 shares. Everybody clear with this part? And I can also find out what is my EPS after buyback. So what will be my EPS after buyback? Earlier, what was my earnings? 30 lakhs, correct? So now this will be 30 lakh divided by 8 lakh 41 to 46. 3.56 rupees per share. Can you write down and finish it off, friends? We are done with this question. Yes, friends, are you done writing this also? Are you all comfortable so far? So we are done with bond valuation. Now we are done with share valuation. Next, we are entering into portfolio management, a little tricky area, friends. Yeah, all done? Comfortable, friends? Great. Shall we take a break now, friends? Shall we take a lunch break? I think time is 1:30. Let's take a lunch break. We'll get back at 2:30 and then we'll have a last session from 2:30 to 4 o'clock. We will do portfolio management. Then tomorrow we'll continue with portfolio, followed by mergers and valuations, followed by forex. All right. Like that, consistently we'll cover up as much as possible. Thank you so much, friends. Please do like and subscribe to my channel and share this video so that everyone can benefit from this. Thank you so much. Have a nice time ahead. See you after the lunch break.